Scott's decision of the Supreme Court, whether a charitable institution or a religious institution registered under Section 12A is entitled to depreciation. So, some high courts were giving a decision saying that depreciation is eligible. Some high courts saying depreciation is not eligible because it's a double deduction. Already the cost of the capital asset, fixed asset, has been claimed as application. Then where is the question of once again claiming it as application? So it amounts to double. Kerala High Court gave Lissi Medical Institution so a negative decision. Thereby the government has put a full stop for such a controversy, and then they said the wording exactly. We are going to see the slide also, but here itself I will touch. In case the cost of the asset is claimed as part of application of income, it shall not be entitled to depreciation. This is the exact word used. So, from 1516 assessment year, every institution, if it was existing up to or before 1415 assessment year, it should bifurcate its depreciable assets into those assets whose cost was claimed and depreciation was claimed, a full stop there. They are not entitled to depreciate. They are, in our accountancy, we have to show the depreciation consistently, continuously. But in computation only, that part of the depreciation is not eligible as application. So, from 1516 assessment onwards, we should have bifurcated the fixed assets into two types of fixed assets. Those fixed assets whose cost has been claimed as application. Those fixed assets whose cost was not claimed as application. Why? Generally we claim no? No, it's not the case. Normally, you take the example of an engineering college. In the first year itself, we got 12A registration. But after getting the 12A registration or starting the trust, what we will do? The trustees or the society managing committee members would have brought some subscriptions, donations, corpus fund donations, maybe 10%, 20%, 30% of the total engineering college project cost. Because the AICTE says, unless you are registered as a charitable institution and the land is registered in the name of the society. Nowadays, CBSE syllabus high schools, unless the land building is there in the name of the trust or society, CBSE board will not give the recognition. So school also should get the registration. Account section. So, the engineering college would have availed a loan, say 25 crores loan, 15 crores the trustees who promoted the college, so 40 crores. But in the very first year, is there a possibility for the engineering college to get the income of 40 crores? No. Because in the very first year, engineering college, only one first year people and the two maybe 4 or 5 sections will be there. Only after 5 years completion a cycle, all the sections, all the branches, maybe it may come in the 5th year, 6th year for a break even. So, what the Income Tax Act says, capital expenditure in the year in which you have incurred only, if you have income, you can claim as application. Here, in the very first year, there is no income. So normally for buildings like big assets, generally no institution in 1 year itself will have sufficient income to claim the cost. So the possibility that before 1415 itself, some assets you would have claimed the cost as application from the income, for some assets you would not have claimed. So, to the assets for which you have claimed only, you are not entitled to claim the depreciation. For the assets which you have not claimed the depreciation, you could not avail the cost, then those assets are eligible. So that's how you should make it into two. Number one. Number two, this amendment, is it retrospective or prospective? It's only prospective. Number two, after this, that is from 15-16 assessment year, you know now for which asset you can claim, for which asset you cannot claim. So, in your fixed asset schedule, you should maintain in such a way, though for accountancy principles, for all the depreciation is calculated, for all the assets. For computation sake, we should bifurcate them into two separate groups. Accordingly, we should continue to claim depreciation. And the last word about the depreciation is at which rate the depreciation has to be calculated. Section 32 depreciation, normally our mind tilts, quotes time and again held. Section 32 is nothing to do with this. Here depreciation is a commercial rate based on the life of the asset. A normal natural depreciation one has to claim. So this is about this amendment. Then third, we are having substantially financed. Quotes time and again what is meant by substantially financed, where it is used in section 1023C, small 3AB, educational institutions. So all the universities, you take University Grants Commission availing, UGC funds availing, state universities, central universities, they are all autonomous bodies. So every autonomous body, being an artificial judicial person, is bound to normally compute the income if it is having taxable income. So this 1023C small 3AB exclusively those institutions which are substantially funded either by the central government or state government, their income is totally exempt, unconditionally. They need not file the returns. So, in 14 Finance Act, what is meant by substantially financed is defined, 15% or more. And then 2015 Finance Act, they were made to file the return by amending section 139. So from 16-17 assessment year onwards, all such government funded educational medical institutions are now from 16-17 assessment year onwards bound to file the return of income. But the whole question, because I am dealing with two universities, the whole question, are they maintaining the accounts on double entry bookkeeping? Are they preparing their income statement balance sheet up to 15-16 assessment year? Anybody who is dealing with the university here, sir? At least Pallavaram Municipal Corporation? Anybody? Because I have gone there, taken a class for because the ICI Institute insisted double entry bookkeeping system, local bodies, new standards. So they wanted me to take a class, so I have gone there. So these universities, majority, central universities are following double entry bookkeeping system, accrual system, balance sheets. But state universities, majority, yes, on this date also, those from 16-17, the return filing is made mandatory, are not following double entries. What they are following? Receipts and payment account. Receipts and payment account will fail budget. That itself is the audit by the local fund auditors. So, from 16-17 when they made it mandatory, it's becoming very difficult for them because these universities are 50 years old, 100 years old. Usmania University, Hyderabad, 100 years old. 100 years old buildings are there, equipment is there, each several departments are there. Andhra University, 75 years old. SV University, 54 years old.
But they are having balance sheet.
What is that?
You said they are following receipts and payments account. They are having balance sheet.
No. No balance sheet, no audit. For decades. But now you have to file the return of income. The return of income, unless you follow the double entry bookkeeping system, even under a cash system, let us say. But the governments have insisted they should turn into accrual system. So I have converted 2 universities into double entry bookkeeping system. So the experience I am trying to say, the institute is having sufficient material how to convert a single entry good old institution into a double entry institute material in the website itself. You can download, you can follow the systems, procedures, and then you have to do it. So the government slowly want all of them, though they are all funded substantially by the government, they want them to file the return of income and claim the exemption under 1023 small 3AB, not necessarily having 12A registration or not necessarily section 11. But though their total income is unconditionally exempt, they should file the return of income. Government wants it. So that is the substantially financial amendment. From 1617 actually return of income filing by those institutions is made mandatory. Then 4th amendment. For fresh 12A registration, not to reopen early registration. This is the beautiful amendment. Majority of our professionals are not using this liberal benefit. The present government, which has come to power in 2014, realized that several temples in Tamil Nadu, which are all managed by Hindu Religious Charitable Endowments Act government officials, are not having 12A registration, are not filing the return of income. I am quoting only Tamil Nadu because I am here, but throughout India. So, as per the Income Tax Act, every temple is a separate entity which has to file its return of income. Only claim exemption under section 11 having 12A registration. But majority are not having. In 1996, the power to the Commissioner of Income Tax who can condone the delay of application under 12A was withdrawn. Only from the first day of the financial year in which the application is made, exemption is available. Though it was established 10 years, 20 years, 30 years back, in the year in which financial year you apply, from that year the exemption is available. For earlier years, it is taxable. So, this government, without giving that retrospective, giving power to the commissioner, simply amended saying, in case an institution, trust or institution, applies after this amendment for 12A registration, A, if the registration is granted, B, though its earlier assessments are pending, the assessing officer shall take as if the registration is available, assessment shall be completed. C, after obtaining this registration, for earlier years, if the conditions of this section 11 are fulfilled, no 148 notice shall be given. So, income escape, generally when you apply, you will be filing what you are doing, 3 years accounts you are filing. Majority common mistake what they are doing, while applying form 10A, that is the prescribed 10A under section 12A, first 3 years returns you will file and acknowledgement and statements you will file, which is a blunder, don't do it. Simply audit the earlier 3 years, enclose the audit report and the accounts along with form 10A, don't file the return of income, because this amendment section says, in case you file, because the 10A asks only 3 years audited accounts, it is not asking you returns, copies. So if once they give the registration, the officer is prohibited to reopen, though you have got income, because deemed application. So this is the benevolent amendment which majority are not utilizing even now after that. So better people should avail this benefit and then apply now, comply, because if I go to an extreme step, if I apply earlier 6 years also, they will reopen. So they are postponing getting the registration, afraid of going to the department and brooding on the subject. Rather than that, the government given liberal thing, one should avail and do it.
Sir, temples are charitable institutions.
Pardon, sir?
Temples, religious entities, are they charitable institutions?
Sir, religious institution is separate, charitable institution is separate. Temple, you are asking, temple is a religious institution, not a charitable institution. Religious institution is also as good as a charitable institution. On its own, if it is having income, it is liable for taxation. Unless they get the toll registration, their income is not exempt. Gross income is taxable. The whole difficulty of these charitable institutions, which I am going to in another few minutes tell you, for 18-19 assessment year, if merely the return is not filed by September 30th, you have toll registration. You have applied 85% of your income. You kept all your monies as per section 11.5 mode investment. No violation from your side. Everything the institution has done. What it could not do, by September 30th it has not filed the income. What is the amendment now for 18-19 assessment year? Section 11 exemption is not available. Section 11 exemption is not available means your gross income, donations, you have applied for public purpose, charitable, temple receives normally hundi collections, normally some ticket sale, something. So the gross income, without allowing the deduction, if it is taxable at 30%, how much serious difficulty? See the example. An institution is having 10 lakhs income. Institution applied 9 lakhs. Its surplus is only 1 lakh. But because it has not filed the return, on 10 lakhs, 30%, 3 lakhs it has to pay. Where from it will pay? So that is the 18-19 onwards. So the section 11 exemption, if they have to avail, especially it will come after some time, 11.1d, any specific direction donation shall be excluded from the word income, 85% to apply. So that 11.1d you can utilize only if you have only a registration. Capital receipts you can keep separately in the FDs and only revenue receipts apply 85%. You are safe in running the institution. But if 12-year registration is not there, 11.1d is not there.
But there's a recent case law which says that even if 12AA is not there, any corpus donation will be treated only as corpus donation. It will be taken directly to the balance sheet, not to be treated as income for purpose of section 11 or section 12. I think there is one recent there's one case law. It specifies that irrespective of non-availability of section 12AA registration, corpus donation should be treated only as corpus donation. And
there are 4 important decisions of the High Courts which Sir was mentioning. Up to 17-18 assessment year, those decisions of earlier years, judgment may come now. To which assessment year it relates is more important. Up to 17-18 assessment year only, even if 12-year registration is not there, capital receipts, like one person gave a land as a donation, 1 crore land. No, 1 crore land is not taxable, though 12-year is not there. That decision Sir is referring. Yes, sir, that is valid up to 17-18 assessment year. From the 18-19 assessment year, it is not valid. So those decisions are relating to early years. The law is amended. So I will explain it, sir. So from 18-19 assessment year, nothing doing. It is fully taxable. So that's all. To see all these consequences only, where our topic is the amendments of far-reaching effects, especially for 18-19 assessment year, as we are finalizing the accounts, unless we see these recent amendments effect. So assuming that we all know about the normal computation, normal income for this charitable institutions, what special amendments, special features are there, we are going to specially deal today. So the 12-year registration, If you obtain, there is no point of reopening. That is the amendment. Then the next amendment, cancellation of registration. There are two sections, 12AA3, 12AA4. 12AA4 is the amendment. Before that, 12AA3 was there. 12AA3 was saying, based on the conditions for grant of registration, the commissioner to examine the application in Form 10A, the commissioner has to examine A, the genuineness of the persons and the society or trust who have floated it, genuineness. B, the validity of the objects. Are they really charitable? Are they really religious? So only the objects he should examine. Only these two things, nothing else he should see. That means in the past 6 months, what activity you have done? They are now asking, you have applied 6 months back, now I have to decide, have you really opened a bank account? Have you contributed money? Have you started the activities? Sir, it is irrelevant, sir. No. To prove your genuineness, I am asking. Indirectly, route to his coming. Sir, we are all having PAN number, we are all reputed people. Unless you give the registration, if I give it, it becomes taxable. So 30% you want to collect. First you give the registration, then I will give. No. First you give the money and you use the money for a charitable purpose, then I will give the registration. That's how it's going on. So, that 12AA3 is having only two conditions. They have introduced 12AA4, very silently hitting amendment. If there is any violation of section 13(1), that is a ground for cancellation of registration. As I told you, 11 is an exemption section, 12 is a get the books audited, if your gross receipts exceed 2.5 lakhs, registration process. 13 is a negative conditions. That means if any of these conditions, if are situations if you are following, you will lose section 11 exemption. Section 13 says, in the following circumstances, section 11 exemption shall be forfeited. So section 13(1) lists out A, B, C, D. So 13(1) A, 13(1)13(1) For example, 13(1) Any money is invested or deposited other than section 11(5). Majority of the schools, July, August, because of a lot of admissions, they get some surplus money. The Income Tax Act says only in the specified modes of deposit investment. They will be tempted to lend it to XYZ, deposit in other than scheduled banks, private banks. So, violation of 13(1)(d), 13(1)(c), related parties transactions whereby related party gets the benefit. 13(1)(b), any charitable institution giving any benefit to a particular caste community. 13(1)(b). So, if these violations are there, then from 1516 assessment year onwards, Commissioner is having the power to cancel the registration. So now, what is the procedure? How to cancel? After cancellation, violation is in 1 year, cancellation is in another year. Now in between what happens? Based on this section 12-year registration, if 80G is given, what happens to donors if this assessment is without exemption? So these things in the coming slides we'll see. So that is the cancellation is a dangerous power, a very serious thing. So how to avoid that situation? What are all the serious things? In fact, this word 12-year registration cancellation now is such a dangerous thing. For example, we are having Pachappa College. It's a public trust. So many big trusts. Biggest to say Pachappa College. Pachappa Trust is the biggest trust. Thousands of crores properties. So, if once you cancel, The Act says all its present assets market value minus third party liabilities is the accreted income. On that accreted income 30% tax they have to pay within 14 days of cancellation. The Act says section 115 TD, which I am going to touch upon. So cancellation word is such a dreadful one. It is not tax on income, it is a tax on property. So that is the result. How it is, we will see. Now I am dealing synopsis. In detail again we will go, depending upon the time availability. So then 115 BBC, it's a clarification amendment. 115 BBC, anonymous donations. So, first precaution, for religious institutions having 12A registration, they can have anonymous donations. It is but natural. Many people go to church, they will put their money. Many people go to temple, they will put their money in the undi. So they will not write their name, address and then put it. It is for the Lord, let him utilize it. So what this anonymous definition says, if the donor's name and address are not available, identifiable, then it is anonymous. So the person who gave is identifiable, then it is not anonymous. So for charitable institutions only it is available. So some of these schools, colleges, at the entrance of the main gate, they keep Goddess Saraswati statue and their small hundi they keep. So why you invite a problem, if at all an income tax fellow visits it, he will say, you are having some anonymous, have you offered this? So there should not be any hundi in a hospital. Majority of the hospitals which are having 12A, they keep one hundi. They will keep one pillar statue and then in front of him, this money goes to staff, scavengers, or poor patients. So they put a inscription on the hundi box and they put the hundi. It's all an unnecessary headache. So anonymous donations. Now, anonymous donations are taxable in the hands of a charitable institution, and to which extent the exemption is available. Out of your total donations, either 5% or 1 lakh rupees, whichever is higher. That means you have 90 lakhs as a identified donations, but 10 lakhs unidentified donations. Your clerk forgotten to take the name, somebody gave money, he is sincerely accounted for. So now 1 crore is the total donations. 90 lakhs is with name. So then what is exempt, what is taxable? So anonymous donations 10 lakhs. So the wording is 5% of the total donations. So on 1 crore 5% 5 lakhs or 1 lakh, whichever is higher. So anonymous 10 lakhs are taxable. Above this 5 lakhs, that means 5 lakhs deduct and the remaining 5 lakhs only is taxable at 30%. That's the clarification amendment. Then we will go to 2015 amendments. So 2015 amendment, because if you open now the ITR 7 for 18-19 assessment year, for all these there are columns. Unless you know this background, why they have put these columns calculation, you will not be able to fill up the ITR 7. That's why the ITR 7 is a little bit complicated this year. So to fill up the ITR 7, all these provisions one should understand clearly and then fill up. Then correctly it will get uploaded, and then no liability will be there. So 2015 amendment, excising option for deemed application of income in the prescribed form. So as we all know, there are 2 routes. In case a trust or institution is not able to apply 85% of its income during the previous year, it has got 2 options. Section 11(1)(a) explanation 2, which says in the immediately following year that the income can be applied. So for your objects, you have 4 objects. For any of the objects you can apply, or for all the objects, for general expenditure you can apply in the immediately following year, provided before the amendment by filing an ordinary letter. But with this amendment, Form 9A is prescribed and you should electronically upload it on or before the due date of filing of the return. Then alone, in the subsequent year, the section itself clearly says, normally if you follow the accrual system, these institutions will have FDs. You will get the higher interest if you put the FD for 2 years, 3 years. So if you put the FD and on accrual system, if you account for the income, that interest you cannot apply 85%. So in the year in which, either immediately following year or by filing form 9A for the income that is not received, though accrued, in the year in which it is received, it can be applied, is the sum and substance of form 9A. So the second route is form 10, which is existing since many years, but that form 10 is any income falling short of 85% by giving a notice in form 10, that is within 5 years following the previous year. If you can apply for a specific object, form 9A, general object, any object I said, form 10 shall be for a specific object if you apply. Form 10. Now that form 10 also on or before the due date of filing of the return, electronically you should have filed. Okay. So if you file form 10, that is a section 11, subsection 2, that was not amended. Actually, it was there as per the rules. Rule 17 was there. Now instead of removing from the rule, they brought it in the section. So instead of the notice, they want it as a statement, the word, they brought it within 11.2. That is form 10. So that is the second amendment. So the 2 are 9A and 10 electronically has to be filed. Within the due date you have to file. It is up to the management to take the decision either to apply within the following year or within 5 years by filing. But majority, if you are not filling up ITR 7 for these two, you should fill up in the ITR 7. ITR 7 simply says, is there any shortfall? Are you opting? Which section you are opting? Next question. Have you deposited this money for which you are giving notice? In where you are deposited? You are opting, resolution, alright, yes, you will come. Then if you come to the next question in ITR, what it does? Where you have kept this? The word used is not income, the money. There is a difference between the word, this income for which you are giving accumulation have you deposited, or the money have you deposited. The courts and the interpretation is, the money means not the same income, same deposit. From some other income or earlier year's income accumulated, if you deposit, then it is sufficient. So the money shall be deposited. So once you give a notice, you are having in State Bank of India 10 lakhs, in Canara Bank 20 lakhs, in some other bank, Andhra Bank 15 lakhs. Your accumulation notice is for 10 lakhs. You should say, Andhra Bank so-and-so branch 10 lakhs, I am earmarking for which I am giving this form 10 notice. Then, next to conditions, second year, third year. Such Andhra Bank deposit only you should withdraw in the third year if you want to apply for such purpose. 3 years back, 15, 16 you gave the notice. Now 18, 19 assessment year. 18, 19 assessment year asked, which year notice you want to apply now? You have applied during the previous year, 15, 16. That 15, 16 deposit only have you withdrawn and used it. You cannot use any other money. The specific money for specific purpose only you have to use it. The ITR asks, it is the intention of the act. So which generally everything in banks are nationalized bank. Everything is drawn and utilized. That is not the act expecting, and I want you to answer in a general way. Specifically you should answer. Okay? So normal WhatsApp joke comes to my mind. If a 10th class and plus 2 student in a over how many balls in a cricket means, normally he says, how many sir? 6 balls sir. The CA question, if it is there in the WhatsApp, CA student is not supposed to answer. In a cricket over 6 balls, if he gives wrong answer, 0. Why? There is only 1 ball, bowled 6 times, provided there is no ball. If there is a no ball, 1 more time he has to bowl. All this lengthy answer, he should write then the CA student. So that is the difference between ordinary student and CA student. That is how the section 11 says, if you want to claim exemption, you should put in the deposit, that deposit 2 conditions. That deposit shall be used for the specific purpose, no other deposit. And that deposit, if you withdraw, as if your notice is withdrawn, in the year in which you withdraw, it becomes taxable income. Though you kept some other money somewhere else, if once you withdraw the deposit for which you gave the notice, accumulation of income, specific deposit, you have withdrawn it, then it becomes taxable income. So, if you try. Third, if you withdraw for the specific purpose you don't say, and some other purpose you utilize, then also you lose the exemption. If you want to change the object, you should you take a prior permission from the assessing officer. A school running an institution gave the notice for acquiring a bus. Now I cannot acquire the bus in the third year. My income is so poor, so please allow me to acquire a computer. The change of object he must apply to the assessing officer. Section 11(3) capital A permits for him to give the notice and then change the objective. So that's how you should do it. So carefully, but casually give the notice. Come on, we'll see when the scrutiny comes. All computer picks up the scrutiny because artificial intelligence for this ITR 7, majority or say, to my knowledge, 10% of ITR 7s have ended up with demand notice. Simplified up to ITR 7.7, now 10% of the ITRs with the demand notices, computer raised demand notice, because this logic has not been followed. So now the 2015 third amendment substantially financed I have already explained because they are made to file the return of income. And then the fourth limb is you are having the definition of charitable purpose, section 215. The charitable purpose includes relief to poor, education, medical relief. The word yoga is introduced by this government as the revision. And then preservation of monuments, and then preservation of environment. And the last limb is, earlier it was the fourth limb, last, when four say items only were there. Now it is the last item. Advancement of another object of public utility. In the definition of charitable purpose, last limb is advancement of another object of utility. And this section 215 is having two provisos. Those two provisos are only with relation to advancement of another object of public utility. In the case of advancement of another object of utility, A, such institution, if it undertakes any activity in the nature of trade, commerce or business, or any service in relation to the activity of trade, commerce or business, it is no longer a charitable purpose. First proviso. Second proviso. First proviso will not apply in case, for 1819 Assembly Amendment I am saying, earlier it was there. In case gross receipts by way of fees, any other consideration, in carrying out such trade, commerce or business, if they were 25 lakhs or less than 25 lakhs, first proviso will not apply, second proviso. The 25 lakhs is removed now, they kept the present amendment is 2010 they kept 25 lakhs, 2015 they have amended it to 20% of the gross, total gross receipts. That is the present 1819 Assembly year for which we are now dealing. If receipts in the course of such trade, commerce or business, if they are not more than 20% of the total gross receipts, then the first proviso, that is advancement of public utility is not a charitable, will not apply, double negative. Okay? So first is one negative, and for the negative, second proviso, double negative. So this is about the definition of charitable purpose with an illustration. In my next slides, I am going to explain these provisions with some illustrations. So the 2016 amendment, tax on accredited income. Dear members, as we know, the Income Tax Act broadly two types of taxes it levy. Taxes specified in the Act, taxes on the general income as per the Finance Act of every year. The budget prepared and presented to the Parliament. So the government tax rates, it will change year after year through the Finance Act, which rates are applicable. So in the specific rates, you are having section 111A, short-term capital gains taxable at 15%, some long-term capital gains at 10%, 20%, 112 section. So 115 you are having a, so you just know we have seen 115 BBC 30%. So 115 BBE, very for normal assessees, any income which is falling in 68, 69 ABCD shall be taxable at 115 BBE 30% up to 16, 17 assessment year. From 17, 18 assessment year, 60 plus 15 surcharge, 75 plus penalty, it's 85%. So, like that, this section 115 TD only for these 12-year registered institutions. In case registration is cancelled, already I have explained you, or in case they are no longer entitled to registration under 12A. See, in case they merge with some other institution which is not entitled to, which is not having 12A registration, in all such cases, their accredited income means market value of all their assets minus the third party liability shall be taxable at 30%, that is 115 TD. And if there is a delay, interest shall be payable, and all the trustees are deemed to be associates in default in addition to the trust. Trustee is a defaulter in case. So, if trustee is not complying the law, not only the trust, all the trustees are also associates in default. That is 115 TF. So, we are coming to 2017 amendments which are applicable for 2018-19 assessment year now. We are dealing with this 18-19 assessment for which we are filing the returns. So, this 2017 amendments, first amendment, as I have told you, if the return is not filed for 12A institution or 1023C institution, now if the return is not filed before the due date, if there is a delay, the income becomes fully taxable. What is income means? Gross income. Section 11 exemption is not there. Section 11 exemption is not there means 11(1)(d) is not there. Even though you apply 85%, that 85% is expenditure is not your application. So capital receipts, revenue receipts, maybe a last straw. Once due date cross, even you are paying the tax without exemption, 5,000 rupees also please add. Because due date is not there. So this is the implication, very 2017 amendment. So priority should be given. In case of tax audit, you are not filing before the due date. What happens? Anyhow, that 5,000 rupees plus interest only. In a tax audit case, a business a return, you are not filing before the due date. Nothing will happen. They may try to give 271 capital B penalty notice if with due date. But there are 273 capital B. 271B is the penalty, 273 capital B is if there is a reasonable cause, even that penalty can be dropped. 99.9% cases no penalty is levied. In fact, in the past 3-4 years, sir, for delayed filing, no notice is given, no penalty notice is given, thousands of cases, lakhs of cases. So, late early file, nothing. But here, you cannot be that, say, attitude you cannot take, because we don't want to levy any penalty. We will only withdraw the section 11 exemption. That is sufficient. So, this is the amendment. Then comes...
Sir, corpus donation. If we file the return belatedly for 18-19 assessment, what happens to the corpus donation?
It is your income. Please pay 30%. So, corpus donations will become income. You have to pay 30%. That's what I am saying. So, once you are filing belatedly, you will lose the... They are not cancelling the registration, nothing doing. So, simply, you lose the exemption. Section says amended. So, corpus donation also is income. Then taxable.
But expense not allowed. No expense allowed.
Pardon, sir?
Expenses.
Ah.
Not allowed here.
Sir? Sir, the expenses allowability, once you are not having 12A, For example, if it is a hospital having 12A, so hospital, is it claiming for the gross receipt section 11 exemption or is it claiming exemption for net income? First question. Second question, what is income for a hospital? What is income for a school college is, you are taking the gross receipt on conditions. It is not a donation, first thing. So, if you are having the receipts to fulfill an obligation, your expenditure is an obligation. So, income, the word, that gross receipt minus expenditure allowable, remaining is income, which loses section 11 exemption. But if you take a temple-like thing, where majority donations will be there, though you use the donations for your expenditure, that expenditure is not deductible from the donations. You are incurring the expenses. Sir, this year you got good donations. Instead of the ordinary gold crown, you will put a diamond crown. Diamond crown is application because you got the donations. Sir. But 12 years you lost. Sir, I incurred the money for temple whitewash, maintenance. They are all discretionary, no expenditure will be allowed. Gross donations will be taxable. So the section 11 exemption, you should be very careful. If it is withdrawn means, what are the consequences? We will discuss. Anyhow, briefly I have answered you. If you have still doubt, we will continue. Okay, sir?
Filing of return is compulsory by digital mode, by digital signature or electronic mode, or by online filing. What is required? What is 1890?
Sir, your question is if there is business income only compulsory, otherwise no. That's what?
For charitable institution, filing of return filing, whether you have to use compulsory digital signature or
correct. Yes, sir. So, this ITR 7, is it a physical return possible? That is our question. Is it, sir? No, ITR 7, the audit report is digital signature audit report only, online report only. As I told you, Form 9A, Form 10 is online. No physical form is removed. So, it is an online process only. No question of even audit report. The auditor should send them, they should accept it, attach it and then file the return. So, everything is online, sir. Everything is online. Any other question, sir?
What is asking is online is okay, whether digital signature is required or not.
Sir, that online filing, again you are having three possibilities, no? EVC, electronic verification system, three possibilities are there. If the bank account is attached, if demat account is there, or digital signature, three possibilities are there. Online filing they said, digital signature mandatory they didn't say. Online filing mandatory, that three possibilities are there. Once you file online, the three possibilities are there. Any possibility you take. So, we have seen the first amendment of 2017. Coming to the second amendment, corpus fund. Earlier, many people used to, up to 2003, I am going back. From the business, I inherited a business from my father. My father writes a will saying, my son, you please inherit the business, but 10% of the business income in my name, you create a charitable trust, use for CA students, CA education. So I inherit the business, 10% of my business profits, I pass a journal entry to so and so Mr. X Memorial Educational Trust. So I transfer the funds also sometimes. Pass a journal, claiming business expenditure. It is allowable business expenditure. Because I inherited the business with a condition. The condition is allowable, tax avoid. Then this trust really will not spend 1 rupee per CA students. Only accumulates bank FD. Then, 85%, in those days 75%. Then it has become 85%. So accumulate. Notice, Form 10. In those days 10 years, it is reduced to 5 years. So fifth year what they do? By this 5 years, I myself will create another charitable trust. Now this time I will say for poor people relief. So 10th year, the accumulated income will be given as a gift to the second trust. Second trust again after some time to third trust. So without spending, the money will be in some assets of this trust. Just like the political people creating the, normally if they want, limited companies. Because they are having so many followers, what they do? One limited company with 100 shareholders, that limited company will buy one property in Mount Road. So next year another limited company in Ekmore. So the limited company is acquiring property. You have seen all these things. So trusts are also many. So what they have amended, any trust from its current year income, if it gives a corpus fund donation or any donation to other institution only, it is application. From earlier year's income, accumulated income, if they give the donation, it's not application. That was the old amendment. Now the present amendment in 2017 is, from the current year income, if you give an ordinary donation to another 12-year registered institution, it is application. If you give a corpus fund donation, it is not an application. That is the amendment. Why? These institutions which are not having, which are not really applying their income for their objects, in the month of March, shortfall is there. Better you give a check to some other institution. That some other institution will give to some other institution, third institution. The third institution in fourth year or third year will give maybe the same donation. Anyway, I will get back my donation. So, income tax, no, Form 10, come on, do that. They have put a full stop by this amendment. If you give a corpus fund donation, no, you should give it for revenue. Thereby the receiver, the giver claiming it as deduction, corpus fund donation to others, as application. They were doing. Whereas the receiver, sir, it is a corpus fund donation, I need not apply use the money, I keep it in the bank FD. So they were doing. So now for the giver they didn't touch it, for the receiver, for the giver what they said, from 1890 announcement year, if you give a corpus fund donation, it is not an application. You cannot file Form 10 also, because that money is not there in your hands, you have already given. So you must necessarily pay the tax. So that is the amendment effect from 1890 announcement year. So corpus fund donations given, they didn't say corpus fund what, because in section 11, 12, 13 there is no word like corpus fund. Specific direction donations, it's equal to corpus fund only. So specific direction donations are not to be treated as application of income from this year. Next, third amendment. If the trust adopts or undertakes, these the unknowingly majority of the institutions are hit by this amendment from 1890 announcement year. To which extent it is there, I will give an example. 3 days back, our SIRC chairman, I am a SIRC member, our SIRC chairman 3 days back gave a appeal to all the members, Kerala floods are there, please liberally donate. He himself has donated 25 lakhs. We are all contributing. But what this amendment from 1890 announcement is saying, what is your object? Other than the object, if you take any other activity, it amounts to adoption, modification of your objectives. If you adopt or modify your objectives, within 30 days if you don't apply for fresh 12-year registration, your registration is deemed to have been cancelled. Majority of the schools in, let us say Chennai or any other institution, what they do? Kerala floods. Come on, please connect. Give the checks. I am opening a separate bank account. The Act principles, if you don't follow, you will repent subsequently that your given exemption is lost, then becomes taxable. For example, 1023 small 3 AD. What is 1023 small 3 AD? Below 1 crore, every street corner school is claiming without 12A registration, without 1023 registration, if it is solely existing for education, If its gross receipts are less than 1 crore, it's exempt. Only return of income has to be filed under section 139 4C. So they are all filing. But majority of the schools, what they do? Floods in Chennai, give 2 lakhs rupees, 5 lakhs rupees donation to Chief Minister Relief Fund. What is Chief Minister Relief Fund? Relief to poor. Relief to poor, is it your objective? If you have relief to poor objective, you are not entitled to small 3AD. You should be solely for education. The section says any adoption or modification of objectives, department need not identify. If you do it on your own during the previous year, from the day you want to implement or you have already implemented, within 30 days you should apply for a fresh 12A registration. If you don't apply, okay, if the first 12A is given, then this old 12A is deemed to have been continued. If you don't apply, 30 days is over, then finish. As if your registration is cancelled. How much danger it is. I stretch a little bit. For 18-19 assessment year at least, earlier also you should have done. Whenever you are auditing a charitable institution, religious institution, accounts, for the sake of issuing Form 10B, the audit report, keep the objects on the left hand side. Every virtual expenditure, open the columns. You are having 4 objects. For which object this expenditure is incurred? You can incur general manager salary, office salary, electricity. Electricity is not for object, for maintenance of office. So general expenditure is also allowed. So which object you have incurred the expenditure, you prepare, then certify Form 10B, you are safe. Otherwise, any expenditure is expenditure. The main object will be relief to poor, Annadana. But what they are doing in Chennai city itself, I have seen one trust, live example. Some poor people are admitted in the hospital, so to discharge they are not having some money. So these people gave the check in the name of the hospital. That poor people, hospital, bed charges, extra incurred. Is it your objectives? Every charitable objective is not all. You have only some objectives for which you got the registration. For those objects only you are supposed to spend. Don't apply for anything and don't think that everything is an energy equal to charitable. Because in the definition charitable is there, it is not your this thing. The income tax department is not that charitable to consider your case liberally. They want first to deny the registration, get the tax. So one should be very careful in auditing.
No, advancement of any other public object.
That's a very subject. I am going to take up.
This Kerala Relief Fund, will it not come to that advancement of any other object?
No, it is relief to poor. Advancement of another object, is it your objectives?
No,
even if you argue, but it is not coming under any other object. Sir, please, whenever we read a definition, we should come to the last limb only when you exhaust the first limbs. Interpretation, is it a charitable purpose or not? First, charitable purpose means relief to poor, education, medical relief, preservation of environment, yoga, preservation of monuments. Last limb is any other object, any other object of public advancement of public utility. So it is a last limb. Before inserting these 3, say for example 20 years back there were only 4 limbs. What were the 4 limbs? Relief to poor, medical relief, education, advancement of objectivity. But as they are introducing, they never introduce their 5, 6, 7. They introduced in the middle. This advancement of another objectivity is always at the bottom. Why? That is a residual class. So once you give, it is relief to poor, not advancement of another. For argument's sake, I am bringing clarity.
Kerala Relief Fund can also be for poor people.
Okay, relief to poor, is it your objectives? What I want to say,
Advancement of any other
that on your own you cannot assume I am doing advancement, you cannot say. In your written bylaw memorandum, there should be a provision for that object, advancement of another object of utility there. For example, this Tyagaraja Gana Sabha, Narada Gana Sabha. What they are coming? They are coming in this advancement of another object of public utility. Football Promotion, Cricket Association, ICC, BCC, this, that. They're all coming in advancement of the objectivity. So, under which limb you are falling, you should see the charitable purpose. So, if you fall in that advancement also, yours is charitable purpose. I am not denying that basic argument. But expenditure should be for your objectives only, not for general charitable purpose which is approved by the Income Tax Act. Income Tax Act approves something else as a charitable purpose. But your accounts, your audit shall be for your objectives. Don't step outside. That's what the Act contemplates. Am I clear, sir? Please. So, this third limb of 2017 we are seeing is the trust adopts or undertakes. Here a small thing. The word trust includes society, for your information. As far as 11, 12, 13 is concerned, the word trust includes society. Normally as educated people, society is act, trust is trust act, how can trust include society? If you go to Maharashtra Public Trust Act 1950, the definition of trust includes society. That's why majority people sitting at the CPE, that act only they interpret trust includes society. That's why for a society, if you want to apply, what you should do? AOP within brackets trust. Trust nature is, the society nature is AOP. But unless you within brackets T you are not having, the fourth letter, you will not be entitled to use ITR 7. Okay? So, this is a very, very difficult thing, which accredited income, cancellation, registration, if you don't apply. So for 18, 19 assessment and onwards, this danger, how many people, 18 March is over, 18, below 18 they would have spent the money left and right. So now for 18, 19 we are certifying that no violation, everything is perfect registration, we are certifying. So whether their registration goes cancels or not, our certificate whether gets cancelled or not, we should be worried. That is better or this is better. So to that extent this amendment is there. Then comes ATC limit is reduced to 2,000 rupees. It's a political party's donation. So 13A, capital A, like that ATG, 10,000 rupees earlier, any amount, then some few years back they made any donation if it has to get a deduction, ATG, 10,000 rupees. That 10,000 is reduced to 2,000 rupees. And then this is the 56 to 10. So sir's question, I told you, no capital receipts. Sir, the Income Tax Act is mainly to tax the income, not the gains. The word difference between income and gain is, the gain is not earned but fallen on you something, capital gains. So the capital receipts to the extent specified charging section 45 and read together with the definition of 224 are only capital gains head taxable. Other than capital gains head, any other income is taxable unless it is exempt. So normal revenue incomes are all taxable under other than capital gains head by default unless they are exempt. Whereas capital gains chapter, capital gains are taxable, only specified capital receipts are taxable, others are not taxable. In between, the Income Tax Act wants some capital receipts also as taxable income. So this 56(2) is introduced because 1/10/1998 the Gift Tax Act was abolished. Everyone was receiving left and right the gifts. So 6 years they have seen. One state chief minister every day used to wear with the photos and the camera. Sir, this is a 1 crore worth garland. All currency notes as a garland. Today 1 crore my friend Vijay Reddy gave me, next day another person gave me. So all in the books of accounts, income tax. No tax, sir. Public photo is there, newspaper also. He has given me 1 crore. Gift Tax Act is abolished. So 98 to 2004, everybody was receiving left and right the gifts. So 2004, the section 56(2) was brought. Gifts are taxable, though they are capital receipts under the head other sources, not in gains, capital gains. So the 56(2)(7), slowly 56(2)(4), then 7 was replaced by 56(2)(10) from 2018-19 assessment year. 56(2)(7) was applicable for individuals HUFs. Any gifts are taxable. Only limited companies, if they get share premium more than their share net worth, that is income in the hands of closely related companies. Then partnerships to a limited extent. So that limited piecemeal 56(2)(7) was removed, substituted by 56(2)(10) under the head other sources. Any person, A, any sum of money, B, any sum of money, B, any property, property includes movable property means this, immovable property means this, is other source income. So now the any person 56(2)(10) covers trusts also. So those trusts which are not having only registration or attend to the registration are covered. So earlier quoted editions, where is the taxable income? Capital receipt, income definition, which head they will tax on? Specific head now they have given from 1819 assessment year. Any capital, any immovable property. For money, aggregate of receipts 50,000 rupees. For immovable property, each property 50,000 rupees. So in my next slides, I am going to show you. So the decisions related to capital receipts for the trust up to 1718 is different from the current year 1819 assessment year onwards. Specific head, specific section, taxable. So this how should be. And similarly, 269 ST. Highly debatable because tax audit for the past 1 month we are all discussing about the July 20th onwards. Now today is August. July 20th they included 269 ST in the tax audit report form 3CD. So we have been debating what is 269 ST. Cash received in one day from one person by any person irrespective of the number of payments aggregate. So for one transaction different dates 2 lakhs or more. Third, either on the occasion or event, in relation to an occasion or event or occasion, even if a different thing, that is 269 ST. Event is not defined, occasion is not defined, transaction is not defined. One Madras High Court, transaction means 1000 years back, Tirukkural. Transaction is defined in the Tirukkural. One Madras High Court in an income tax case has given earlier in some other context what is meant by transaction. So the words, how to interpret. Now my simple question, these trusts also all these days left and right were receiving cash, but now even if it is a only registered religious institution, somebody wants to give physically cash, but if the ones receive, even if I identify the person, 115 BBC anonymous is not there, I can identify that person. For giver, no problem. For receiver, you, the trust. Any person, 269 ST, they didn't say trustee is excluded. Charitable purpose excluded, religious purpose, nothing is there. So, in addition to it being income, penalty is there. Because 269 ST, the danger is, for revenue transactions it is applicable. Sales I made 5 lakhs sales, one bill and then received 5 lakhs. 5 lakhs is becoming part of my income. You pay the income tax, you pay the penalty also. 271DA with respect to 269 ST. So, the 100% penalty in the trust case also, why should we say? I have seen with my physical eyes, several medical colleges were receiving in bags the fees. Big bags, one has to take the bag, you put the bag. Because medical seat, 1 seat is equal to 1 crore. PG seat means 2 crores. Even in Chennai city. So 2 crores, please bring cash, left and right they are receiving. Now 269 is applicable to any institution, even a trust. So the danger while auditing, while issuing, while going through the books of accounts, one should be careful. Now the 2018 Finance Act applicable only for 1920 assessment year. But anyway, as a precaution, because from 1/4/18 these amendments are effective. What is the amendment? 2 amendments. In only one proviso, both in 1023C and in section 11, a proviso is added. to section 11(1) and 10. What is that proviso? The provisions in computation of profits and gains from business or profession. From profits and gains from business or profession, the provisions as contained in section 40 small a and 40 capital A 3 and 3a, mutatis shall apply. The word mutatis would have read in the contract in ditto, 100%. We are importing. So for 1023C and section 11, they imported these two, which are applicable from 1/4/2018. What it means? A 20,000 rupees expenditure limit to more than 20,000 rupees. 269 ST, 2 lakhs or more. 40 capital A3, more than 10,000. So this 40 capital A3, any expenditure, for your information, some majority of the colleges, they come for audit. Hariyar, you are having 25% surplus income. Why, sir? 85% you should apply. If 15% shortfall is there, more than 15%, there is a possibility some of the high courts have interpreted not for profit motive. That means consistently you are getting 25% income. 12A given can be forfeited. 10(c) given can be withdrawn. You should exist for not for profit in the act. You are getting every 20% surplus. That means you are not reducing your fees. Same question was put to ICA Institute by Delhi High Court. Every year you are having surplus income. Where is the question of non-profit motive ICA? Withdraw. Internal Department gave the notice and the High Court also saw it. Then somehow our intelligent argument, no. It's a statute created institute. Profit motive or not, keep aside. Profit is incidental. Give, okay, we got 1023C, 4, which was withdrawn by the department. So you refer in the Google, you will get all this case law. So the institutions, what they do? Sir, salaries increase, sir. How can I increase here? To bring it down to, yes sir, my engineering college, I have to, as per AICTE rules, I should employ 5 departments, 5 professors, 5 assistant professors, 5 assistant lecturers. Then you would have paid by check to them. The prescribed salary by the UGC or AICTE is one thing, actually lesser. Then daily 10,000. So that lecturer's salary is 60,000, you assume. That fellow would have paid 15,000 only. So 60,000, 10,000. So they were doing so many things. So they brought this amendment. These institutions also more than 10,000. Please pay by through bank only. Check or cross account pay, check or DD. Similarly, TDS. Because the specific section 40A is any business expenditure you should incur if it is of the nature mentioned there, salaries, interest, rent, commission. So specific, all the TDS sections they didn't say. Expenditure related some TDS sections, the 194C contracts. So the specific sections they said, if you are not incurring, if you are not subjecting the payment to TDS, it will not be allowed. So the TDS related disallowance is 30%, 40 capital A3 cash payments, 100% disallowance. Okay? So several subsidiary questions are there, which in my slide I am going to show you. So now we will go to the other details. So the exemptions I have dealt with. So the section 10 exemption, 10(1) and 1023C, I have explained you. So in detail once again I am explaining you. Some more interpretational issues I am bringing down. Actually these interpretation issues are more important in understanding the provisions. So though they brought the amendment, that is not the end of it, because how to understand them, how to apply them is more important. So the double deduction depreciation, I have explained to you. WDV method you can follow, and the depreciation, if you are having already a WDV, so how to continue it, as I have told you. The cost of the asset, actually the word application, income shall be applied means revenue expenditure, capital expenditure. In the computation only you should show the difference between the revenue expenditure and capital expenditure. In the preparation accounts, audit report, form, though there is no form prescribed, that is the for the P&L account and balance sheet, your revenue items in the P&L account concept, balance sheet the capital items, maybe capital receipts you will take to corpus fund or specific fund. So your principles of finalization of accounts, true and fairness is not going to be mattered. But in computation, in the balance sheet and P&L account, better you prepare a R&P also, or accrual system funds flow statement. Thereby your capital expenditure also you will claim as application. But revenue expenditure, capital expenditure alone are not sufficient. There are 3-4 other items which I would like to explain to you, though not related to this amendment. For example, I gave you an engineering college initially started with a bank loan of 30 crores. It has taken up the project cost of 45 crores. So the bank loan, term loan has to be repaid. In the first year you constructed the building 45 crores or 40 crores, let us say. 40 crores you could not claim as application. Over. Income is not there, no application. But in the subsequent years, when you get the income, what you will do? You have to repay the loan. Interest you would have claimed as expenditure. Now the principal repayment is application. So courts held consistently that any loan repaid is an application. So the capital expenditure also, during the year if you have building fund donations, so partly with your income, partly with your building funds you have constructed the building, then you cannot claim the total building cost as application. Building cost minus building fund donations or corpus donations you remove, remaining only from your income applied, remaining only you should claim. So this is how the computation part of capital expenditure, how to claim. Inner column, one should be very careful. Similarly, if you have sale proceeds of a capital asset, one capital asset is sold and another capital asset you acquired. For example, the same college, it sold its one building with land and it acquired another land and building. Now how do you compute the income? Your sold land and building is book value is 10 lakhs, sold for 1 crore. Now you purchase new building for 80 lakhs. Sir, I am giving you the example. In the computation, these interpretational issues, how it will come, I am giving you the examples. So in your books, you are having land and building worth 10 lakhs only, book value. You sold it for 1 crore during the previous year, 17-18 related investment year, 18-19. Now, during the previous reserve, section 11, within brackets 1 capital A says, whenever there is a capital receipt on account of sale of asset, the sale proceeds, if they are fully utilized to acquire another asset, it is no longer an income. During the year, 80 lakhs you have invested for another land and building, suppose. So, Now 1 crore is the receipt. Your gain is equal to book value you remove. 10 lakhs, 90 lakhs. But 90 lakhs is not your income, provided had you invested 1 crore. You invested 80 lakhs, then not a proportionate ratio. 90 minus 80 you should deduct. Remaining 10 is your taxable income. So the capital receipts, and actually the government is liberal in saying any capital receipt, even if you keep for 6 months as bank FD, is deemed to be a new asset acquired. That 6 months also courts have interpreted. Where is the sanctity to the board to give a circular that 6 months new asset shall be acquired? Any new FD is a new asset. So even for lesser period, if you put the money as FD and after that you have withdrawn during the previous year also, is not income. First you converted the sale proceeds into a bank FD. So bank FD is a new investment. If there is a new investment, it is sufficient. And it is not taxable. So whenever there is sale proceeds, capital receipts of not only fixed assets, even the investments. Investments means say shares, securities, then government bond share securities, these institutions can invest, mutual funds. So the sale proceeds are capital receipts. So once you have the capital receipts, invest them in another capital mode or bank FD. Then only that bank FD is sufficient, you will get the deduction. So now I am coming to the depreciation with
indexation is permitted.
Pardon?
Indexation is permitted.
No question of indexation. Computations of capital gains is 100% ruled out. We are not going to touch the provisions of the indexation. Is only in section 48, which is there in capital gains chapter. Capital gains chapter is not applicable to this institution. These institutions' computation is a separate code. So no indexation. No indexation. So here the loans repayment, for example, earlier somehow you got excess income, you could not give form 10, you filed form 10, you paid the income tax. Income tax is not your object. To pay the income tax will not be there as one objective. You paid the heavily income tax. Is the income tax application? 85% you should apply to your objectives is the section. So is the income tax payment application or not? So the courts held income tax is an application, deducted. If we are not saying that on income tax again income tax will come. So if they have to necessarily allow even the wealth tax, income tax as a deduction application only. So like that the interpretational issues, what is the meaning of the word application, just I am saying because we are dealing with the fixed assets. So you have to apply the income 85% where repayment. In fact, courts held an education institution gave the scholarships to students. Those scholarships are nothing but debtors like thing. That means to a student they will give a scholarship. They take a bond from the student after I completing the education and on I getting an employment. This scholarship I will repay to you without interest. So this scholarship will become a revolving fund. They are taken. But some students generally abscond, generally they will say, I will not repay. It is not a legally enforceable thing, morally. I am giving you a scholarship. But so then you have to write off. Then the courts held the scholarships originally given itself you can take as application. If you are not taken, on the day you write off, it is an application. Courts held it. These are all case law. Courts held the moment you write off, it is an application. Write off means not money paying, it is writing off. Then also it is application. So what is the word application? Liberal meaning. So much only through courts. Because Indian Act simply said 85% you apply. Then what is meant by apply? So liberally courts have given number of decisions. So the asset cost, you have to keep it under the appropriate depreciation method consistently you should follow and then claim the depreciation as application. So the cost of acquisition claimed, that's what from 1516 estimate here, I have explained you. Then the depreciation, other charitable purposes, it cannot be actually. Now my second 2-3 questions. A college, Bachappa college is there. It is on the Poonamalai High Road and another road is also there. It constructs shops abutting that road because it gets more income. So sir, genuinely, I got some money. I constructed some shops. So shops construction is a capital expenditure. Can such capital expenditure be claimed as application? Sir, capital expenditure can be claimed. Can the shops construction be claimed as application? No, courts held. For your objects, you should incur the capital expenditure. Any capital expenditure means anybody, any capital expenditure they will incur. So for your objects, that capital expenditure should be there. For your objects means for students have constructed an auditorium. That auditorium is a capital expenditure. So your object is education. For a hospital, some laboratory you have constructed. So it should be related to your objects. Otherwise, say it's not courts held it. The interpretation issues I am saying. So for a temple, jewelry is in section 11.5 itself mentioned. Section 11.5 itself jewelry they have mentioned. Furniture they have mentioned. Immovable property they have mentioned. So specified modes of investment. So from your income you bought the jewelry. Definitely it's an application because it is a custom in a religion. Say God shall be decorated. So that's how. So the income should be upright. So the 15%, how can we keep? Where to keep? That's a question.
Sir, in case of depreciation, you are telling us, suggesting us to have two set of depreciation table, wherein the assets which are acquired out of the income, for which I can claim depreciation. The assets which are other way around. So 100% application claimed for those assets, no depreciation. I have borrowed some money from the bank as term loan and acquired some asset out of it. For that I am entitled for depreciation because that asset is not claimed as a capital expenditure. My doubt is, in the subsequent year, when I repay the term loan, am I entitled to deduct the repayment?
Yes.
Will it not be double?
Where is that?
deduction?
Sir, no, there is no double deduction. In the year of borrowal, you yourself admit asset has come from borrowal. Asset is not from income, so you are not entitled to, though you have sufficient income, you cannot claim that cost of the asset as income, from income I acquired, you cannot claim. So asset you cannot claim. So second year, third year, you cannot claim the same asset cost. Earlier year I have not claimed now. During the previous year you should incur. This previous year you have not incurred any capital expenditure. So capital expenditure part gone. Then liability part. Whenever you repay the loan, you are claiming. So where is the double deduction?
Sir, I have purchased a vehicle, purchased a bus out of a borrowed fund. In that, on the year in which I have purchased the bus, I have not claimed the capital expenditure.
Okay, you cannot claim the cost of the bus.
Cost of the bus. That year I am entitled for depreciation for that bus.
Well, sir, see, the assets for which original cost is not claimed from the income, their cost definitely you can claim as depreciation. So depreciation is an allowable item. So you have been claiming depreciation for the bus. Okay.
For the bus for another 5 years. In the 5 years, I am repaying the term loan wherefrom I have borrowed.
Okay.
Whether that term loan repayment can be claimed as an application.
Yes.
So if you allow both, will it not be double deduction again?
Correct. Why you are claiming the depreciation? After repayment of the loan, if the bus value is becoming zero, if you want to buy a new bus, you should have the cash. So the concept even for the business people, depreciation is allowed. Same depreciation here also the concept. So the deduction is enabling you to accumulate some cash, thereby a new asset can be purchased. Thereby a new asset can be purchased. So that is the concept. So the depreciation where the original cost is not claimed is allowable. So depreciation as per commercial principles. Loan is, when you receive the loan, it is not income. When you repay the loan, definitely it's out of your income you are repaying. It is allowable as application. The concept courts held.
So during the assessments, the officers are specifically asking whether you have treated the repayment of loans as application. If you say yes, then they are again tracing back, seeing that when the loan was taken, how it was utilized. If you are utilized and treated that as application, they are not allowing this.
His question is very valid question. If you are borrowing for a working capital, they will not allow the repayment of loan. If you borrow for a capital expenditure, they are allowing. That is the difference. So, if you borrow for a working capital, sorry. So the borrowal is equal to expenditure. So for your automatically, if you are using for revenue expenditure, they will say, so you used the money not for acquisition of a capital asset, because acquisition of a capital asset only is entitled you to claim the cost of the asset. That's why loan repayment I am giving. But if you are borrowing for a working capital, your money is used for revenue, you are claiming once, and again repayment of loan second time. So that is the difference between these two. If you borrow for a capital purpose term loan, definitely you can claim.
Is it given any specific notification kind of, or is it just an
No, these are all court's interpretation only. Loans repayment, number of decisions are there. I will give you the decisions. So if you go through the decisions, what arguments both from department and SSC, based on those arguments, you should come to the conclusion.
Sir, as it is not specifically provided in the Act, I am entitled to claim depreciation as well as repayment of loans.
Correct. So
It is not specifically provided. That is the reason why I am entitled. Otherwise, I think I have to take in that way. See, the logic you are telling, replacing the asset by accumulating the, taking something from the profit as depreciation, is a good old concept, is existing even in the case of asset borrowed out of own funds.
That is there. Their original cost treating as application for other than charitables will not arise. Capital expenditure, the business head section, capital expenditure is not an expenditure at all in the business head. So depreciation is given. So there this logic 100% will apply. The whole controversy in charitable trust is capital expenditure is treated as an application. So depreciation, is it a double deduction or not? So the government wants, once we give the capital expenditure, for the same asset we don't want to give the depreciation. Clear, clarity.
His question is, where depreciation is allowed, can the repayment of that particular loan be allowed? I don't.
You are right. You are right. So the distinction with your own funds, if you buy the asset, with your own income, if you buy the asset, you are given the total cost. With borrowed funds, if you buy, I don't give, the department cannot give. The difference you see. So borrowal has to be paid one day or other. So the borrowal repayment, courts held. These are all the opinions of the courts, not our individual opinion. So the difference between an asset being acquired with borrowed funds and own funds. The borrowed funds, if you use for an asset, as the asset cost is not capable of treating as application because it's borrowed money. So the borrowal cost, repayment also is given. That's it. So these are the court's decisions. You please go through the decisions, the logic you will understand better. The decisions, how the courts have come. Because the department argued like this. It is not to be given, not to be given. But the
doubt is, if an assessing officer going back of the earlier year account returns and say already you are claiming the repayment of loan, again you are claiming depreciation, it is not acceptable if he says. What is the aid in the Act for me to...
because the provision in word and spirit, if the original cost is claimed, depreciation is not to be allowable, only is the amendment. Beyond that, nothing, words are not there. So they are not linking as we are discussing the loan. If such asset is with loan, loan shall not be claimed. They are not amended. Courts interpreted the loan repayment as application is not there in the sections. It is by interpretation of law by the courts. So only court's judgment if you read, you will be understanding there because it's not in the specific section.
By discussing, they will bring an amendment.
If they want to bring a loan repayment also not to be allowed, they should bring an amendment. They didn't bring like the depreciation controls.
Thank you, I got it.
Yes, sir.
Sir, it's a capital asset, like a property is sold by the charitable trust. Can it be used for the objects of the trust?
Why not? It is income. You use for your objectives. They didn't prohibit you. If you want to avoid paying the income tax or treating it as income, they gave you a method. Section 11, subsection 1 capital A says, whenever you sell a capital asset, just like your 54 BF exemption, here also section 11(1)(a), whenever you have a sale of a capital asset, if you invest it once again, it's not income. If you don't invest, it will become income. That income you apply for your objectives, no problem. They didn't prohibit you. They didn't prohibit you.
Suppose Trust A and Trust B both together are doing a project. So Trust B is actually expecting a fund to be received by them. But by the time the project has to be completed, so project A is giving a loan of say 50 lakhs to Trust B, and both together are completing the project. But in the subsequent financial year, the fund which are supposed to be received has not been received. So now Trust A fund, the loan which is being received by Trust B, can it write off or should it be treated as a receipt?
So his question, how far you have understood, I will repeat the question for my understanding also. Trust A is there, Trust B is there. Trust A and B jointly have undertaken to take up a project. Trust B has to invest 50%, Trust A also has to invest 50%, let us assume. Trust B, when it could not mobilize the money, A said, on your behalf I will also spend. So A has spent the money in the first year. In second year, which the B trust promised to repay, has not repaid. So Trust A has to write off in second year. What is the legal consequences is question. Is it right? First of all, A trust should have 12-year registration, B trust also should have 12-year registration. Then both of them enter into an agreement without profit motive. My object is similar to your object. To achieve that non-profit objective only, let us use this money. Should be there in the agreement. Carefully, because unless you take this care, money for any purpose anybody can spend means automatically the moment you part with the money it become income. Second year, third year you forget. First year itself the money if it is used for other than objective, finish. So for similar objects both should be there because one project. So both should enter into an agreement. In that agreement I will spend the money, you will spend the money. In case one falls short, the other can advance. In case the others are not advancing, again writing off. All these things should be there because it is a trust. The trustees are dealing with it. In case the officer interprets that the trustees have entered into transactions in such a way that is a breach of trust, because it should not become a colorable device to part the money, this route, ultimately money lost, sir. So many trusts, they enter into transactions in such a way, the trust will not realize the money, trust money will go. Ultimately, sir, it is loss, sir, it is some activity loss. So the courts and income tax department, are you really a trustee without loss, as if your personal money have you taken abundant care? So in the first year books, if you say money recoverable from trust B, to the extent acknowledgement, legal right to collect should be there with you in trust A books of accounts, that the money is given, it is recoverable, legally recoverable. So it is not an application, loan given. So within the objectives, yes, a 12-year registered institution, a school, another one is a college. School wants money. College surplus, they can give a loan to this thing because both are having education, similar objects, both are having 12 AA. and there some 15% surplus is there. Out of that surplus they are giving a loan to this thing. Nothing wrong. So for objective purpose only, instead of I applying, I am not treating it as application, loan only. Out from the not 85%, from 15% only I am giving. And again take back, nothing wrong, no violation. But in your case, you are writing off in the second year. If you are writing off in the second year, if it is for the objects entered into, writing off is application of income, allowable. If it is not for the object, writing off is not application. Then taxable income may come. So two possibilities.
For the trust B, how they have to show in their books of account? They have to show it as a receipt or they have to adjust to capital account?
No.
Because the loan received is now not going to be repaid. So they have to treat it as a receipt or they have to adjust it to capital account?
You are right. So for trust B, so trust A bad debt written off application because what happens to trust B says. So trust B, first year it will show as payable. Once it is payable, expenditure it books. For the project expenditure it books and payable it says. That means you claim excess expenditure. Second year you are not paying 1 rupee and they are writing off. Your outstanding liability will become 0. Then bring it back to income because earlier you claimed expenditure. Now it bring it back to income. That is the correct way. So income means taxable pay. It becomes taxable because you are not applied 85%. This is cash not spent income entry. Then also it is income. So earlier you reclaimed expenditure. So that's why in the charitable trust, the 1 year excess expenditure can be deducted in the subsequent year income. This is also case law only. There is no specific section. So earlier year B trust claimed the expenditure without money, with its own money, no money on journal entry basis. A payable to A. Second year payable to A is disappearing because it is becoming income. That means that is the correct way of taking it.
Now previous year excess utilization, can it be brought forward?
Correct. So number of decisions, any trust, if it is having in 1 year, 2 years, earlier years excess expenditure, there is no carry forward of loss provision specifically, but earlier years excess expenditure can be set off from the current year income if current year income is there, as if deemed carry forward loss. Number of decisions.
But in the return of income, sir, when we show, suppose this year's receipts are say 1 lakh, I have utilized 1,25,000. The return is not accepting it, sending back error saying that your receipts, your expenditure is more than the receipts. So it is restricting you to show only 1 lakh as your utilization. So what happens to that excess utilization?
No, we can say out of borrowings you can incur expenditure. Where is the necessity that out of income only one should incur the expenditure?
You have received an error, so it's not accepting.
We should see that schema. So if you have specific problem, you give me, I will try to solve the problem. No problem. Even what I could not solve, I will write to CPC and I will get you the solution. A number of times the CPC director, these people, they respond to me. So I interact them, they give a solution. I will pass on to the same solution to you if it is not done. Yes, sir.
The corporate social responsibility scheme, the company already donates 10 lakhs rupees.
You come here. I am not able to read this.
Under CSR scheme.
No, not adequate.
Under CSR scheme, a company, a private public limited company, donates say 10 lakhs to a charitable trust for construction of a school, building, toilets, etc. The charitable trust also spends say 9 lakhs 50,000. Example, say up to 10 lakhs he has spent. Whether we can show it as a revenue expenditure, under the income and expenditure, whether we can show it as revenue expenditure and claim it as an application, instead of showing it as capital expenditure. Because it is not a capital asset for the charitable trust. It's only a collects donation and spends money. Though it is a capital expenditure, though it's a construction work. This is my doubt is, I want to show it as a revenue expenditure and claim it as an application, not showing it as an asset of the trust. Is it correct?
This is a common question. Sir only specifically I asked. This is a common question. Charitable trusts receive monies to take up social cause public expenditure. Social cause public expenditure. That expenditure can be a revenue expenditure or a capital expenditure. Generally, So, a charitable trust received, say 10 lakhs rupees. With 10 lakhs rupees, it has constructed for a school toilets. Is the land and building belongs to charitable trust or somebody else? First question.
Somebody else. It's a government building, school building.
It's government school building. It is natural. We all here, we collect some money, so we go and construct a municipal school, a toilet. Now we have gone constructed. So now Sar's question. In the charitable institution books, how do you show it? Revenue receipt, revenue expenditure. Capital receipt, capital expenditure is the question. As far as the computation of a charitable institution is concerned, for such things, though your accountancy, even if you receive a capital receipt, for a computation it is a revenue receipt. For a computation it is a revenue expenditure. Because the land is not yours. On somebody's land you constructed a toilet building. So there is no right to what is capital expenditure. A capital expenditure is enduring nature. The benefits will percolate over a period to the organization, is an asset. That is fundamental. So here for the charitable society, where is enduring benefit, where is a continuous convertible again and again, nothing is there. So it is a show it in the revenue side income, the receipt from the company, show it as expenditure, toilets expenditure in the revenue expenditure. That is the answer. Clear, sir? Second question, subsequent question. Please. A very common doubt why he said. FCRA deposit you will receive, FCRA grant you will receive. Same purpose. I am running a Rama Social Welfare Society. So this Rama Social Welfare Society receives from Germany 50 lakhs. What is the 50 lakhs? You should, for 50 schools, you construct a extra library building. So generally it will take 2 years, 3 years to construct the library buildings. Now the question is, I received, unless their money only I will spend, I will not spend 1 rupee. Mine is a charitable institution. I send the project report. They have given the money. What the FCR will say, keep it in the separate bank account. For the specific purpose, specifically you spend. Don't mix it with your ordinary funds. So what you will do, in the liability side, FCRA grant from Germany, asset side bank balance. Whenever you spend out of this 50 lakhs, 50 crores, one library building, one school building, one toilet building, you are withdrawing, and your liability side grant also you are reducing. How do you compute and file in the return of income? Two possibilities, a better possibility I advise. Two possibilities are, this is only in the year in which you spend the money, that much only you take as your income, you applied. Compute both the things in the computation, not your income and expenditure account. Income and expenditure normal, balance sheet normal. But in your computation for this particular society or trust, to the extent you applied, you take as revenue receipt and apply. This is the first possibility which majority do. I say there is a 50% danger. The assessing officer will say the money received is for you to spend either current year or future year. Money received is your income. Why you are not admitted? At that time you cannot file Form 10, Form 9 when I taken up, time is over. Danger, you are taking 50%. Second possibility, what my advice is, you received 50 lakhs. You spent only 15 lakhs. You admit 50 lakhs as your income. File form number 10 for 35 lakhs. I am going to spend within 5 years. You are 100% safe. This safe method only you adopt. In the balance sheet only you show 35 this side, 35 in the bank. But doesn't matter. But you should take this route only. You will be safe, though case is taken for scrutiny. If you forget this, it makes a lot of difference. The SSC will not be knowing all these simple entries. The assessing officer will try to catch hold of you on the wrong foot. This is the advice. Yes, sir?
What will happen if it is on the own
sir,
ground? What will happen if it is on the own ground? Instead of third party land, your own land, you are building it, you can still capitalize and take it as an application.
Yes, yes. Sir says, I am a school on my own land. I want to construct a toilet, but somebody gave a donation. Doesn't matter. The donation, if it is for a specific project, section 11(1)(d), corpus fund donations. Out of corpus fund donation, you constructed neither income nor application. Nothing will come in the computation. Without receiving donation, you are constructed on your own. From your income, you constructed. So in the computation, your normal income less toilets. Then you claim it is an asset, though it's allowed. This is how we should do it. Sir, shall we proceed? Because some more slides are there. We have to complete in the given time. But I contemplated in the beginning that question answer should be minimum for 1 hour. I think 40-45 minutes we spent only for question answer in between. So somehow object is so we are also mixing revenue and capital. So the substantially financed, I have already explained you that especially the close button. So the government funding, please be careful. Here also lot of common questions. Nowadays governments are giving fees reimbursement. Is fees reimbursement a grant? In Tamil Nadu also it is there, no? Fees reimbursement is there, sir. For an educational institution, what this section says, 51% or more if the government gives grant, it is a substantially funded institution. For a substantially funded institution, irrespective of below 1 crore, above 1 crore, mere filing of return is sufficient, its income is exempt. Now, government, what is government funding means? Government grants. The word, if you read that rule 2BBB, it says grants from governments. Now, my question. Fees reimbursement is giving, government is giving fees reimbursement. Is fees reimbursement a grant? Anybody who is dealing with education institutions will be knowing you have 40 students, engineering students in Andhra, it is 5,000 crores per year the government is spending for engineering students. Everything fees reimbursement. You have 40 engineering students into 35,000 per year. Grant is given, not grant, fees reimbursement is given. Now that fees reimbursement, is it a grant? Based on that, is it substantially funded or not, and then taxable or not, we have to discuss. It's a question.
It is not.
It is not a grant. Yes, sir, anybody else?
Fees reimbursement also takes 3 years to get.
Pardon, sir?
Fees reimbursement also in Andhra Pradesh, it takes 3 years to get there.
Takes?
3 years.
Reimbursement to give. That's a very good question. Sir, governments assure you to give the fees reimbursement, but not in the same year. Normally, student means 3 term fees. In a year, first term, second term, third term. All the 3 terms tuition fees, as you rightly said, after 3 years they are giving. So, I asked the majority of the institutions to turn into, because they are following cash system. If they follow mercantile system, this fees receivable from the government, they should show as accrual basis income. If they show accrual basis, the income will be more. They are not really having loan funds and then incurring. They are only increasing the expenditure to match that and then claiming the fees reimbursement. So, I asked all of them to follow only cash system, not to follow mercantile system. If they follow mercantile system, every year filing form 10, and in the year in which they receive, again incurring the expenditure, they cannot again show the expenditure. So, follow the cash system. So, it's taking 3 years time. Okay. So, this is the difficulty. Substantially financed fees reimbursement is not a grant. The grant nature is grants generally can be capital grants, revenue grants, UGC grants. So for a specific purpose, specific meeting and expenditure is the already incurred expenditure, fees is due from students. They should give the name of the student. Based on the student's income certificate, they reimburse the fees. So it is not a grant, as I rightly said. So that's how it is not funding, grant. Now, several universities, because in America, majority of the government universities, they don't depend upon the government grants. They sustain with the projects from the society. In America, majority of the universities. In India, majority of the universities are all depending upon the government grants. So, the government has slowly in the past 10-20 years self-supporting courses. So, for example, MCOM regular course one will be there. Those who are not afford to pay higher fees, they will join in the regular MCOM. MCOM self-supporting course will be there. That means same syllabus, same teachers. But another section where fees will be higher fees. Those who could not get with normal fees there with their master, those people will go to that self-supporting course, engineering, in all the universities. Engineering, ordinary engineering, self-supporting course engineering. Fees difference will be there. So, those self-supporting courses gross receipts are not substantially funded. So, majority of the institutions earlier from up to 15, 16, 17 assessment year, government institution no difference between the government grants and revenues, whatever may be the gross receipts. Now if you look into from 16, 17 assessment year as the return has to be filed, though it is 100% government managed, government controlled, government operated university, it is not substantially financed. The government grants will be less than 50%, the self-supporting course fees, other income will be 51% or more, thereby it is not substantially financed. Thereby unless they have a 12-year registration, income becoming taxable. The logic are you able to understand, sir? It is a 100% government promoted university, but government promoted university, so long as the grants are 51% of the gross receipts from the government as grants only, without 12-year registration, unconditionally exemption. Now it is not the case. They are running the courses from the students, they are collecting the fees and they are running. This students' collection fees and their early savings interest, all these things are coming to 51% or more. Government grant is falling below 50%. The moment they fall, they should obtain for their registration. Otherwise, say this exemption, blanket exemption, they are losing. So this danger, majority are not aware. As I am dealing with universities, I am trying to highlight. There are some funded schools. You will call it as aided schools. General common words. Aided schools means what is the aid? What is the unaided? There will be posts, sanctioned posts, aided posts, unaided posts. So you should be careful in dealing with these things, these words. Otherwise, say you will lot of trouble. Sir.
Year after year it may change. 1 year the government grant may be 15%. Subsequent year it may fall. The next year it may go up to 50%.
Maybe.
In that case, what is the precaution? I have to safely take 12 a year for all the years. First year
Be safe. Because, sir, there is a circular from the CBTD in connection with advancement of another object of public utility. In case 1 year it will become non-charitable because that more than 20%. 1 year it is below 20%. CBTD circular said because of it losing its charitable nature, it will not lose its 12-year registration. It will become taxable income 1 year. Next year again it is having 12-year registration, below 20%, still it is entitled to 12-year registration. CBTD gave a circular after this amendment. So same case here. Because of the amendment, 1 year it may become taxable, 1 year it become exemption. So this is the problem. Are you able to understand, sir?
This aided schools, the salaries are directly paid to the teachers only. It is not given to the institution. Whether the substantial...
Then it is also grant. Your expenditure is met by giving you to teachers or your teacher salary from their account now online they paid. Your expenditure meeting, somebody gave the money, it is a grant. It is a grant.
Substantial question we can answer.
51% or more of your gross receipts, then it's alright. So that means students' fees you are collecting something and salaries also reimbursed by government. That salaries reimbursed portion, if it is more than 50% of our total gross receipts, it is substantially financed. Am I clear, sir? So these are all more interpretational issues and we should be careful after these amendments. while filing the returns, dealing with the cases. So, then I have explained you the benevolent amendment. I said early arrears shall not be reopened. 6 years they will reopen normally by issuing income escape section 147 notice to get assessed under section 148. So that notice shall not be given. Okay. So merely because non-registration is there, as if registration is there, their income is deemed to have been, unless there is a violation. So this is the benevolent amendment. So they said, though they got now fresh 12-year registration, in case earlier registration was cancelled or refused, after 2 years you are applying now, for them earlier years cannot be reopened, class will not apply. So bottom line, if you see, so never you have applied, never they have refused, never earlier was cancelled, fresh you have applied, then earlier year also deemed to have been applied and got the registration. That's the rider. So one should be careful about these things. So then this registration cancellation provisions, I told you 12AA3 was there since a long time. If the activities are not genuine, activities are not carried out in accordance with the objects of the trust, that was there earlier. Whereas now 12AA4 newly introduced, if there is a violation of section. What is 13(1) violation? I have already explained you. It is only an interpretation. There are cases, a principal of a college, because principal room was under renovation, the principal room refrigerator, he kept it in the adjacent quarters provided in the same college. The inquiry department visited, school asset used personally by a substantially interested person, 13(1) violation, 13(1)(c). So you lose your exemption. So the interpretational issue should be like that. So a car, trust is used. How many kilometers? Where is the logbook? Only for trust purpose have you used. Prove it. If you don't prove, I say that you have used it for personal. If you use it for personal purpose, 13(1)(c). So it's all the power of a department to interpret what is the gain the trustees have got. Substantial donors. Who is a substantial donor? 50,000 or more. 50,000 or more cumulatively. This year 20,000, last year 30,000, also 50. For that person any benefit, directly or indirectly. So these are interpretation issues, number of case laws. So one should be very careful not to come within the clutches of 13(1). For example, a school is promoted by wife and husband. School normally, initially itself, they cannot have land and building. So they have taken their principal's brother-in-law's house on rent. Principal's brother-in-law house on rent. Is the rent reasonable? If you paid excess rent, if the assessing officer proves that rent paid, because in Form 10B, payments to relatives, they didn't say excess payment to relative. Your 40 A2, unreasonable or excess shall be disallowed by the assessing officer. But in Form 10B, if you read carefully, payments to relatives, auditor must mention. How the auditor can mention? Auditor should take a declaration from the assessee that to my relatives I have not made the payment. If they give the declaration, you to say nil. But if once they say, yes, my brother-in-law, I paid the rent from the trust, I am one of the trustees, then you should mention in your report, Mr. So-and-so, his PAN number so. The amount paid is towards rent. Neither unreasonable nor reasonable. Computer is picking up for scrutiny. The officer will ask, for how much square feet, how much? Sir, ground floor is a bank. Bank is paying me 50,000 rupees rent, the brother-in-law will say. Whereas the first floor, I gave it for this small school at 25,000. Naturally, first floor will be less. How much less, sir? Ground floor 50,000, first floor 25,000. So though the assessee proves that it is a reasonable rent, the officer can interpret that is a excessive rent. What's excessive rent? 12A registration can be cancelled from 18-19 assessment year, you see. So the excessive, because you are bound to mention the facts can be interpreted in a different way, which is going to ultimately result into a heavy damage. So one should be very careful with this amendment that 13(1) violation is not there, you should prove, and one should take abundant precaution, otherwise say this trust audit report, in fact 271J what it is, any certification, attestation by the chartered accountant, if it is not correct certification, any wrong certification, auditor is, the institution will lose its 12A registration and pay the tax is different. Added to it, for that interpretational issue, the chartered accountant also is in trouble, you see. So that much danger is there. So one should be very careful. So the consequences, so as I told you, this is the advancement of another object. First of all, if you have some other object which is not relief to poor, medical relief, education, if you have advancement of another object, then during the course of that object persuasion, if any trade, commerce or business, what is trade, commerce or business is not defined in the Income Tax Act. These words are used. Courts have interpreted A. Yours is a public educating health magazine you are running. You want to run this as a charitable institution. So you are conducting medical camps freely. You are taking nominal fees and conducting the medical camps. It comes in medical relief. Okay. So you are taking up an objective that not only helping them medically, you want to propagate health tips. You are printing a magazine. In your object is there health education also, there is a propagation of safety and healthy habits. So this magazine, if your magazine printing cost is 10 rupees, if you are selling for 9 rupees 90 paise, it is not a business. Your 10 rupees magazine, you are selling for 11 rupees. It amounts to business. Once you take up this business, is this business incidental to attain the main objective? Such a main objective is not falling within this advancement of another object of public utility. Maintain separate set of books of accounts. If it is 44 AB above 1 crore, get them audited. Use the income for your main objective. It is no violation. Section 11 exemption can avail. 2 examples. Every hospital is running a pharmacy, medical shop. Hospital is coming in medical relief. This medical shop is business because you cannot sell the medicines for less than your original cost. Less than your original cost if you are selling, the other outside pharmacy fellow also will buy from you because he has to buy for the same cost. So instead of that you are selling for less than cost, he will run his medical shop buying from you the patients. So you have to sell for reasonable profit. Once you sell for reasonable profit motive, you are adding consistently, not one transaction, number of transactions consistently, business, natural. Business is to attain the main objective of medical relief. No problem. What the amendment, the proviso to section 215 charitable purpose is only applicable for, not for medical relief, education. Education, engineering college is running buses. Engineering college also is running buses. It outsourced the buses. Particular engineering college, 20 buses will go in the row in the morning. So these 20 buses, they don't own. Why unnecessarily we owning, maintaining, repairing? They outsource. Each bus per month 20,000. Then average calculate the student. The students who are using it pay 22,000. So year after year are engaged, bus charges are collected, bus charges are paid, surplus is there. It is a business activity. Because your main activity is education. to make the education reach the people, because our college is in the outskirts of a city, because the AICT says 10 acres if you have only, I will give you engineering college. So 10 acres within the city you cannot buy and then run the engineering college. Necessarily you should have it outskirts of the city. So necessary outskirts means students, unless you provide the college, provides the bus, who will go on their own motorbike or their own this thing. Parents will not send the girls. So all these things. So buses are provided. So incidental to main activity. Hostel for college. Hostel, is it self-cost basis or self-sufficiency basis or for some surplus? If surplus is there, is it necessary to attain the main objectives? That's sufficient. But the example I gave, you are not owning hospital. You are only health treatment for poor people, medical relief. But in addition to poor people medical relief, you are printing the books and then selling. Ramakrishna Mission. Ramakrishna Mission, less than their book printing cost they are selling. You don't want to call it as business. Bhagavad Gita, if you go, they say 7 rupees, 8 rupees. Its printing cost is 12 rupees. To avoid this difficulty, sell the less than cost. So public charity. So the advancement of another object. For example, I gave you Narada Gana Sabha. Narada Gana Sabha, to promote the classical education, Indian culture, preserve this, that object is laudable. That is, the preservation of Indian culture is advancement of another object. But once in a while, what they do? December month, season for music and dance. So, sell the tickets. Selling of tickets beyond your cost. On that day, what is the cost? 2 musicians will come and play. Selling of tickets is a commercial activity, profit motive. Advancement orality, your selling of tickets, revenue from the sale of tickets is from the total year gross receipts more than 20%, no longer a charitable purpose. You will lose Section 11 exemption. Because charitable purpose carrying on people only Section 11 exemption. Because you have only a registration, it doesn't mean that your Section 11 automatic. Subject to this proviso. So, one cinema show, one music show, selling of tickets. My advice, don't call it sale proceeds. You call it donor passes. So you take the money. Sir, they have given donations. I have conducted the show. Where is the question of trade, business, nothing is there. The word only is different. So you say donor passes are issued on the festival day. Those who want to please come. So they have come. They have given donations. Donations I received. I have not sold the tickets, sir. So it's only the interpretation issue. Please, sir.
In one particular scrutiny hearing, in case of pre-printed tickets, donation ticket 100 rupees, 100 rupees, 500 rupees, 1000 rupees, I was put a question by the assessing officer. Donation is the amount given by the donor on his own, and you cannot fix the rate. I cannot come and ask you, give me 500 rupees donation. I can ask for donation, you can give me 100 rupees or 1000 rupees. But if I pre-print the ticket, I faced this in one of the hearings, saying that you have already decided the donation and printed the tickets. How it can be hardly called as donation?
But it is up to him to give that 500.
Sir, fixing the amount is not the criteria. Difference between a sale of ticket and a donation is, for your money, I assure you a performance, it's a sale. For your money, I am not assuring a performance. You want to promote the art, you are given the donation. So I have allowed you to come and sit in. There, the care what you have to take, public are also allowed. One word you write, the technique to escape these things. All are welcome. Top brochure. Last bottom line. Public are allowed. Nadungulada idu 5,000 rupees, 2,000 rupees story. These are all the things, because this is a very...
You need not print 100 or 500. At the time of donation, you write and give the rupees 100.
To avoid, but at the time of scrutiny, already over. Our IIT is facing a gone case already. So how to give the life to that gone case is the question. So these are all things, sir. One should be very careful, sir. So in a writer opinion, I say, you, 50 of you, want to invite Ravi Shankar ji to SIRC. For 1 week, you want to have Ravi Shankar ji lecture. SIRC should not be burdened. So, you all, 50 people, this meeting organizing, Ravi Shankar's lodge, hotel, this car, flight ticket, everything somebody has to bear. So the furniture, rent, electricity, you want to reimburse everything. So what do you do? If you open an account and if you say X donation, Y donation, all donation and incurring the expenditure, no loss, no profit, definitely you are incurring tax liability. Simple technique is, Ravi Shankarji Felicitation Committee, subscription for electricity expenses, subscription for furniture rent, subscription for mic, public address system, only subscriptions, no donations. So, subscriptions mean to meet the specific expenditure. Though not 12A is there, no section 11 exemption is necessary, it is a AOP, unregistered society, formed for 7 days, collected the money, money is not donation, for meeting the expenditure is equal to contribution, no loss, no income, no computation. That's how you should escape. Use the words correctly. If all the people give donations, then donations are all taxable irrespective of the expenditure, pay 30%. Even if unregistered AOP is liable under the Income Tax Act. So this is how one should be very careful. Not that I want you to avoid the income tax, but really there is no income. Technically, if somebody wants to come and hit you, you should also be technically safe. So that's how we should be there. So this is how the...
Sir, in terms of this religious trust, for temples they keep the entry ticket or the puja ticket. Will that be constituted as business for them? Because
income, definitely. Any entry ticket in a temple is a income, revenue income.
they are treated as business for them.
But from Income Tax Act, not big danger. From Amendment Act, double danger is there. Those public people who has a public religious trust, even if they construct the temple, once they sell the tickets, the government endowment department is having the power to give a notification. It is a notified temple. Their officer will come and sit. He will decide the expenditure. You decide the income collection part. He will decide the expenditure part. So that is the danger. So any hundi, any sale of tickets, they will come into play.
For DDD also the same thing is happening.
DDD is 100% AP state government controlled public trust. So any, whether Tamil Nadu Hindu Religious Act or Andhra Religious Endowments Act, this is the same thing. So before such cancellation, Commissioner has to give the opportunity. There are principles on latches which we all know. This is the 56-210 I have already explained you. So that is the amendment. That is a very dangerous thing. Because earlier decisions, if you are reading and keeping in mind, for 1819 this is not applicable. They brought the amendment. Capital receipts are fully taxable unless, actually the wording in 56-210 is, by or from, this proviso is not applicable. This clause will not, 56-210 is a clause of a section. Section, subsection, clause is 10. So they say gifts are taxable for inadequate consideration or no consideration. For no consideration or inadequate consideration, if sum of money is received or if a property is received, property means they are given. So, like that they are given. Provided in the following cases, the above clause is not applicable. A. From relatives. That means gifts relative again defined as defined in 56-7. 56-7. So, like that, there are 4 clauses which say 12A 1023C registered institutions by or from. So what I want to say, I am an individual. I receive scholarship from SARC. Institute ICI gives scholarships to CA students who are all poor. As SARC, I have also sanctioned some scholarships, recommended scholarships, ultimately sanctioned. So, scholarships received by a student for no consideration from a 1023 CR fully registered is not income. Similarly, a trust which is unregistered, it receives from another fully registered institution. The question is, see, the 56-210 is framed in such a way, if it is having 12A registration, gifts received by it, either in cash or in kind, 12A registration, automatically section 11 exemption will go, 56(2)(10) will not apply. Second possibility. It is not having 12A registration, it received money, it received immovable property, then under this particular head it is taxable. As you rightly said, sale of tickets, if sale of tickets, some activity may go under business or profession. But these donations received, it will not go under business or profession, it will come under 56(2)(10) other sources head. This section 56(2) is in other sources. Once 12A registration is not there, income shall be computed under 5 heads. So this 56(2)(10) includes revenue receipts and capital receipts. This is the logic. So gifts received by it and from 12A registration somebody receiving the gifts. Both are covered by this section. So one should be very careful. So without 12A registration, all these days some temples, some institutions have taken care of somehow. But from assessment year 1819 onwards, it's a very dangerous thing. That's how one should be careful. So this is how I say. Then ATC 2000 rupees also I have explained you. And then cancellation part I have already explained you that if at all it cancels the question, is it prospective or, for example, now the scrutiny is there. Few days back, assessee should have received the notice for 17-18 assessment year. Because from 17-18 these amendments are heavy. So for 17-18 some violation is found. The assessing officer will complete the assessment levying the tax. Same assessment order he will send it to the commissioner. I recommend it for cancellation of 12A because he has violated, I have seen in my books. So in the assessee's books he has seen the violation. He recommends to the commissioner. Commissioner, by the time he cancels, it will be March 19, 2019. Now the question is, once during this 18-19 if he cancels, is it effective from 19-20 assessment year or my 18-20 assessment year for which already I claimed exemption and filed, will it apply? Are you able to understand the question, sir? The violation is there in 16-17 financial year, assessment year 17-18. 17-18 now only is taken up for scrutiny. Now the violation is found, confirmed by the commissioner. Commissioner gave a notice and then said, I am cancelling. Now by the time the commissioner has to give a notice to the trust and then cancel, reasonable opportunity. And that order is also appealable. So commissioner order also, every commissioner order is also appealable to tribunal. So now, in case you go to tribunal, what will happen? When the finality it will reach? Till that time what will happen? So the cancellation, is it from a prospective date or is it from a retrospective date from which the violation is found? These are all the questions not answered by the courts, but my personal individual view is it is only prospective. For what has gone already, how can you now say it's not applicable? How can I imagine that I have already violated and paid advance tax, paid the interest, all these things? It's not possible. Only prospective is my interpretation. So,
sir, Commissioner has to specify the date from which cancellation is taking place or while passing the order.
Yes, you're right. Commissioner, I have found this violation, I am cancelling the registration, he will say. Even if he is silent, on the day he signs the order, from that day only it is cancelled. He cannot go back from a retrospective day, I am cancelling, that power commissioner cannot have. That's why the case law also I have given. So, this for earlier cases. So, under 12A 3, that case is there. So, okay, so these are all the questions. Then we will go to 115 BBC, I have already explained you. Actually 115 BBC amendment, earlier 25 lakhs they want to give more benefit to smaller people. That's why we are bringing it to 20% of all gross receipts, they said. But some people may be below 25 lakhs even now. Because of the amendment, they are more burdened than the earlier 25 lakhs limit. 115 BBC, see the anonymous donations, sorry, 115 BBC, not this thing, the advancement of another objective, the 25 lakhs and 20%. 115 BBC is 5% or 1 lakh, whichever is higher shall be exempted. That is as far as the 115 BBC is concerned. The 2015-16 assessment year deemed application income in prescribed form. Please, some of our colleagues who are not that tech savvy, from 16-17 assessment year, Form 10 has to be necessarily filed online, 9A has to be filed online, they have forgotten to file. Simply return is uploaded, claimed accumulation, but electronic filing of Form 10 they have forgotten. So, what is the remedy? It doesn't mean once you have forgotten, it is a procedure. The rule was brought into the section and Form 10 has to be filed on or before the due date. So, section 119(2)(b), the board's powers are delegated to the commissioners. Commissioner is the authority who can condone the delay, see the genuineness. In the return I have already claimed as if Form 10 is filed, but return is filed within the due date. But Form 10 online I could not file. So please condone the delay. Now I am filing Form 10. Commissioner can condone the delay. Once Commissioner condones the delay, you can avoid the tax. So those cases where now only in 17-18 or say you will find some difficulty, please approach the concerned commissioner, exemption commissioner, to condone the delay. It is within his powers. There also up to 5 lakhs tax due effect, commissioner can condone. If it is above 5 lakhs, again board is having the power. So depending upon the monetary tax effect, the powers are delegated by the board to the commissioners. So you can approach. That's
Sir, one more question, sir. Sir, one more question regarding this 115 BBC. Suppose my taxable, my exempted amount is X amount. Can I claim application for that? 15% can I take that exemption?
Anonymous donations?
Yes.
No, sir. Please be careful. Sir's question. Anonymous donations are taxable. Though somebody donated for a charitable institution anonymously, I have utilized this money. Can I take application against that income?
No, not that. Sir, 1 lakh or
5 lakh.
5%.
5% of the total receipts.
That is the gross, whichever is higher is exempt for me. Whichever is higher, it is not taxable at 30%. Can I take that for my 15% calculation, 85%?
You have to take. Please. A very pertinent question, sir. This is a CA student's examination question. Sir, it has come in the examination, in fact. Sir, my donations are 1 crore, sir. Out of 1 crore, 90 lakhs names I am having. 10 lakhs anonymous donation. Now, anonymous donations must be taxable at 30%, subject to an exemption of anonymous donations, 5% or 1 lakh, whichever is more. So, anonymous donations, 10 lakhs need not be at 30%. Out of 10 lakhs, out of the total gross receipts, 5 lakhs, 5%. So, out of 10, 5 lakhs is over. So, what is taxable as anonymous donations? 5 lakhs only. So, the remaining 95 lakhs donations will become your ordinary income. So, these anonymous donations need not be applied 85%. Already I am paying tax. Where is the question of application? So, out of 100 lakhs, that is 1 crore, 5 lakhs is taxable at 30%. Then the remaining 95 lakhs you have to apply. 85% of that 95 lakhs if you apply, you are out of the tax. 85% of that 95 means that remaining 5 also is included. That was not there earlier before this amendment. It was a lacuna that they have corrected. This is an amendment effect. This way. Okay, sir? Then, so 9A form also, I have already explained you. Then the amendments, 115 BBC I have explained you, and then the forms I have explained you. Form 10 also you have to file within the due date. If you are not filing, at least now you rectify. Go back and see whether all the Form 10s are online filed or not. You can verify. Section 11(2) is authorizing you to file Form 10, and then all the substantially financed also have to file the return of income. That's what I have told you. And then the yoga word is there. Please be reminded that yoga as an object, non-profit motive, charitable objective, if somebody is carrying on, it becomes charitable purpose. Yoga as a commercial activity somebody takes up, is it permitted? So yoga teaching, yoga making the people to learn as a commercial activity you take up. For example, nowadays TV is morning 4 to 6 yoga classes. For that they receive, sir, we are also promoting yoga. No, you are doing on a commercial basis. Don't say that you are promoting yoga. If it is on a commercial basis, it's taxable. Non-profit motive, charitable, it should be there. So, activities made to constitute yoga only. So, business activity in pursuit of yoga will not apply. That's what I want to say. Okay. So, this is what the 25 lakhs I have been referring earlier. So, advancement of another objectivity, if it is having, earlier 25 lakhs was there, that was removed, and then they said the percentage 20%. But really, is this 20% working out? You see, it is not going to work out. So that's how it should be part of your main activity. For example, the board circular also in 2008, while they are amending, they said an association, a trust is there. It is a poor ladies or say widows are the members of the trust, or trustee employs these unemployed widows. They make papad, they make some homemade, handmade eatables or say leaves, something which is useful domestic consumption. They sell it in the public. They make for a profit, they sell it. Is it a business activity? Is it a charitable activity? See the thin difference, please see. The poor people, low income people, prepare very manually something, and with that they make the sales. So, profit they are getting. But the object is to make them employable to have a living. It is not coming in advancement of another object of activity, it is coming in the relief to poor. Is it overlapping? The finance minister promised in the parliament, and a board circular has come which says if the dominant objective is relief to poor, it will not come in the advancement of another objective. If the dominant objective should be relief to poor. What for we have carried on this sales activity? Not to make profits like a commercial activity. The commercial activity is different. Here, non-commercial activities, but for living of somebody. So your interpretation issue is very thin line. So one should be very, very careful in this. For example, a big debate, all these urban development authorities. What the urban development authorities will do? They construct houses and sell to poor people, low income people. Urban development authorities. They construct the roads, they lay the roads, they acquire the government land, this urban development, and plot layout, MIG, LIG plots they sell. Courts held, some courts, some because department went to courts. It's a commercial activity. Selling of houses, selling of plots is a commercial activity. So it's not eligible for 12A registration. Your object is social welfare. Advancement of another ability. You are taking commercial activity. Then though it is 100% promoted by the state government, it is not eligible for 12A. Some 10 years this argument went. Finally what the court said, a dominant objective you see. Is it for profit motive? To make the public get the benefit. So once the dominant objective to make the public get benefit, profit is not the criteria. It is not a commercial activity. It is not a business at all. The interpretation issue, is it a business carried on or not? If you and I carry on layout business, layouts activity and constructing lower income group house also, it is a commercial activity. Private people. But if the same government as a public authority, development authorities, when they take up, the courts held, it is through a statute to serve the public when they have taken up. Same logic they have applied for ICA Institute. CA institutes consistent annual reports, student activity related receipts are more. Because of students activity related receipts, every year you are getting surplus. Department's argument is, yours is an education institution. Yours is an institution for education for profit. You yourself audited, gave the income, surplus income. So you are not a public charitable. Why should we give income tax exemption? So ultimately the argument court agreed.
How the fees collected for this seminar is classified?
Pardon, sir?
How the fees collected for this seminar is classified? It is towards the object of the institute in educating.
Natural. The fees collected for this seminar, the institute is a statutory body which is formed to promote, to preserve, promote and regulate the CA profession. Society needs auditors. In the society, public money is used by some people, few people, and those people are accountable to the public. As independent people, these professionals will audit and say, to assure the public, yes, your money is for proper public use. This profession. To regulate this profession, an act has come in 1949. Act says to conduct training, to conduct exam, to select the members, after membership to regulate them. So, unless a continuous professional education is given, the professionals cannot skillfully carry on their profession. That's why fees is collected. This is also part of, this is not a commercial activity. Your question I am answering, is the fees collected commercial activity or not is the question. Yes, sir?
When that be the case, whether
this is not a commercial activity because statutorily we are bound, the institute is bound to train the people, educate the people. It is discharging the statutory duty. Where is the question of commercial activity?
Then why is GST being collected?
As far as income tax is concerned, no problem at all. Coming to GST, is it correct on the part to correct GST?
It is out of syllabus question, but anyhow I will answer. Today is only income tax class. You are asking what about GST? You are asking. Anyhow, I will answer. Sir, the government itself said GST is payable by every consumer of goods and services, be it public, be it government institutions, be it the government. Government is the consumer of services, goods, government has to pay GST. To whom? To the government only. So the GST Preamble Act itself says there is no profit motive or non-profit motive. Keep aside. In the definition I told you, in the definition of CGST person who is providing services, goods, selling, government is also a person. Government is also accessible. That's why railways provide you travel ticket. Railway is GST liable. Where from? Railway will collect from you and pay. So in your ticket you will find GST. So railway, what is it? Railway is a central government department. Government. It is only a department. So CA Institute, if it is collecting GST, means definitely it has to collect because it is providing service to you. So that is the answer.
Finally, consumer is affected, not the government or the ICI.
Sir, that is separate.
Sir, you asked me a question. Legally, what is available? I told you. So ultimately, consumer affected. These are public general questions. Consumers paying GST are affected. It's true. But consumers are affected. Tax when you pay the tax, sir.
Most of the institutions, like medical institutions and hearing institutions, they conduct a lot of conventions and exhibitions. They also make a good profit. But they contend is basically for their own professional members and giving exemption.
Under the Income Tax Act? Sir, for the past half an hour I have been telling you the word of interpretation. So any law cannot 100% clearly explain you all the possibilities in the society and then draft the law. Law has to be understood on its face, some meaning. Whenever there is doubt, go to court. Courts will explain. Court's explanation is, High Court explanation is binding jurisdictionally within that High Court jurisdiction, and Supreme Court decision is the law. As if Parliament passed law, any Supreme Court decision is equal to law. It's not decision, it's a law of the land. So, your question, some medical college, engineering college are conducting some exhibitions. Is the question?
Not college, associations.
Pardon?
Associations.
Engineering associations.
No.
You mean to say real estate people?
No.
Manufacturers Association.
Like Engineers India. like pharmaceutical association, like you have got.
Oh, you're right. I understood your question, sir.
Doctors Council.
Ah, you're right. Sir, sir's question is related to today's topic. Is within the syllabus, sir. What is that? A public charitable institution definition, is it applicable for a traders association, manufacturers association? Is the question in simple. So, traders association, manufacturers association, generally in its objects clause will be to serve the members. Those who are all the association members, if it is exclusively to serve the members, principle of mutuality, this 12A registration is not there, will not be given. 12A registration will not be given, and section level examination cannot be claimed. If it is an association which is serving manufacturers association, this association, that association, who are conducting exhibitions like that. So 12A registration will not be given, section level examination. If they are having public serving, then is it charitable purpose, non-profit motive? Then those activities which they carry on for public benefit sake, if they get 12A, their income is exempt. Otherwise, from exhibition receipts, whatever the expenditure, if they are not having 12A, just like an AOP, they are assignable. Sir, those who are not having 12A, associations, AOPs, ITR file. You have to file. ITR file means from your activities, whatever the surplus you got, you have to pay the tax. If you have 12A, it should be public charitable. For public charitable only they will give 12A, then only you can claim section of exemption. These things, even exhibition receipts also. That's the answer. So, we will proceed further. Sir, 8:30. So that's why two officers have come in, so I should see the watch. So your time is over. So the amendments, sir, quickly we will see. The actual carrying on of advancement of another object of public utility. So then the interpretation 20% receipts we have seen, and then the memorandum also, as I have told you, is like that. It should be genuine charitable activity. Then accredited income, I have already explained you, that is if you lose your registration, market value. This is actually constitutionally, is this amendment valid? Is a very big question. But anyhow, after 2 years also, we have not seen any legal decision about this. So once a institution loses its registration, 12A registration, very dangerous. On its assets, present market value, you have to pay the tax. So one should be very, very careful because of this 115 TD accredited income.
What is the motive for this?
Pardon, sir?
What is the motive for taxing the market value?
Just like in America, a public institution can become a private institution. A private institution can become a public institution. Private institution becoming a public institution is by donations. Simply, I can give my personal land building to CA Institute. CA Institute is a public body. My personal thing. No problem. Private institution, public institutions becoming a private institute, an exit route we want to create. Government thought a public institution, slowly, in reality, some education institutions, though they are all 12A registered, are not for real public benefit sake. They are for the benefit sake of some few people. Government knows that. So an exit route they want to create. With that intention, they started this section saying, on the present market value of all the 10 years, 20 years exempted income built up institution, pay them 30%. Make it private. Go. That's what they want. Under the Income Tax Act, though as an exit route they have provided this exit tax, assume. They cannot continue that activity because AICTE, all other recognitions, even for a small elementary school, unless it is non-profit motive, government will not recognize. In an unrecognized school, which parent will admit their child and educate? In America, that is there. Private institutions also recognized. Profit motive universities are there. recognized. But here in India, only non-profit motive universities can be there. So this for exit route with this motive, they have your question. This is the answer, sir. So, sir, quickly we will wind up. So that's what I said. Even that procedure, how it is there, I have explained you. Modification in the objects, adopted or amended modification in the objects. So the merger, generally many questions come to me. Sir, one trust wants to merge with other, another trust. How to do it? It's a very big procedure. So anyhow, one should be careful, but both should have first 12A registration and then think of merger. Without one is not having 12A registration, then it's a danger thing. So this thing. So then 115 TD, TF I have explained you. So return of income for 18-19 aspect here.
Can a trust and society merge?
Why not? Both are having tolerance. There is no, under the Income Tax Act, not even 1% difference between a trust and society. Both are treated at par. A trust can merge with society, a trust, or a trust, society can merge with trust. No problems. But procedures legally should follow correctly. So this is the return of income if it is not filed within the due date, how it is going to be there. For 18-19 assessment year, as I have told you already in my synopsis, all these are things. Change of objectives, ATG, these 56 to 10 donations, taxable, 1023 exemption, they will get affected. 269 ST, the cash receipts, these are all the things. So for 19-20 assessment year also, TDS is more important. So every trust, there is no tax audit limit like that. Trust right from the first day, if it is incurring any expenditure, TDS prudence it has to comply, and also cash payments should avoid. So these are all the important changes. So sufficiently I have tried to explain you. So if you have any doubts, sir, write down my email ID. I will answer the questions freely. So if you have any doubts, you please give the email. I will try to answer also. Yes, sir. Mic could work.
That 15%, 85% we are applying for charitable, whatever the purpose is, right? What can we do for the 15%?
So from your income, 85% you have applied. What about the 15%? Yes. Sir, that 15% also for your objects only you have to spend, not necessarily. That 15% you can keep if you are not spending, if you are not applying for your object. What you will do? You will buy land for a future purpose. You will keep the money in the bank deposit. You keep it in bank deposit. But the bank deposit should be as per section 11.5 only. So that 15% margin is given to accumulate to meet future contingencies. That's all. 100% if you apply means it's very difficult. That's why they gave the margin 85%. The remaining 15% you should keep in 11.5 mode only. Whether you apply for now or not, it doesn't matter. So up to 85% only you should apply. So any other questions, sir?
So,
one by one, first here. Tell me, sir.
Section 25 companies should, like, they are also non-profit organizations. Should they get registered at 12A?
They have to. Sir, earlier section 25 under the Companies Act 1956, section 8 under the 2013 Act necessarily should apply under 12A and get the registration. Because of the company registration, automatic income tax is not there. They have to register under 12A. Next, sir.
That 80G, donation 10,000 to reduce to 10,000 to 2,000. Is it cash donation or only cash donation?
80G section itself says in-kind donations, 80G is not eligible. 80G section itself says if I donate to a 80G eligible institution, if I give bank check only about 2,000, if I give land of 1 lakh rupees, 80G receipt they cannot give, I cannot avail it. In-kind, in-kind actually not 2,000, 250 rupees. So they have to necessarily be cash under. Through bank only.
My question is, I am giving 11,000 rupees account by check to a trust. Is it allowed?
Why not? 100%.
So this 10,000 reduced to 2,000 is only cash donation.
2,000 and above should be by check. 2,000 and above should be by check. Earlier 10,000 above by check only 80G is eligible for deduction. I am a salaried employee. I want to give donation. But actually what the people are doing? Today 1,000, tomorrow 1,000, day after tomorrow 1,000. Donation at a time 2000 should be 2000 or more should be by check. So today I will give 1000, they will give receipt. Tomorrow 1000, day after tomorrow 1000. Where is the question? So for cash donations, 2000 or more should be by check. That is the answer. Next, sir.
Thank you. For CSR donations, can we give that ATG receipt?
Sir, you are mixing two. CSR is corporate social responsibility. Company should spend the money.
Yes, but they are giving to the institutions.
You receive.
And they want ATG receipt.
Please, what is ATG? Donation is ATG. Donation means unconditional. Generally, CSR is a condition. My money you use for a particular project. So, these are all non-profit motive organizations should receive and use for a particular project because the project has to be approved by the government. CSR funds, not for any purpose, just like that. For projects approved only they should give. So, ATG receipt cannot be given. Because, sir, for ATG receipt, no benefit shall go to the donor is a condition. So, they are getting the benefit of Income Tax Act deduction, Companies Act benefit, compliance. So, Companies Act compliance also is a benefit, statutory obligation they are giving me. So, ATG cannot be. That's all.
One more question. For trust having more than 50 crore income, what is the accounting standards are applicable, or I should go for a mercantile system only?
Sir, any trust can opt cash system or mercantile system, number one. So, based on your operations, I can advise you. If it is a hospital-like thing, go by cash system. Hospital, education institution, go by cash system. If it is some other thing, then go by accrual system. So, which is the activity we have to see. Number one, cash system or mercantile system, it makes no difference. You can opt. The Act, Income Tax Act is not prescribing you. Number one. Number two, in the computation also, is it cash system income? Form 10, Form 9, cash received but not applied. If it is mercantile system, accrued income, whether received or not, surplus income, again apply Form 9, 10. So, because of accrual system, you are unnecessarily going to file Form 10, 9, don't go for accrual system. Better cash system. That's how I advise.
Then accounting standards are applicable?
Sir, accounting standards only for commercial institutions are applicable. Level 1, Level 2, Level 3. But one word of caution, CA Institute and the courts, whenever a business which is incidental to or which is the trust's main activity itself business, somebody is carrying on a business, once the business gross receipts exceed the 44AB limits, 44AB audit is also applicable along with the Form 10B, 12A section audit. 12A section audit gives you Form 10B. 44AB audit gives you Form 3CD. This and that audit also is applicable when you are having some business activity whose gross receipts exceed the 44AB limits. They are not exempting that 44AB audit. That also you should comply. This is the institute opinion and court's opinion.
If the business is held for charitable purpose also, this condition is applicable.
Pardon, sir?
If the business is held for charitable purpose,
yes,
then also this...
that's what I gave you, no? A hospital is having a pharmacy, a medical shop sales are 1 crore. So for medical shop sales, 1 crore, you must have 44AB audit also, and for the notary institution, trust audit also.
Then accounting standards are applicable for entire income.
Whenever there is a business income, you go by the institute standards. For non-business heads, commercial activity, no accounting standards.
What about the GST, sir? GST applicable to charitable institutions?
Sir, GST is applicable to hospital because it is having pharmacy. So it must take the GST registration, and for medical sales, input tax, output tax is a must. That is my advice.
The donation, cash donations, you said today 1000, tomorrow 1000, like that. The section says no deduction shall be allowed under this section in respect of donation of any sum exceeding 2000 rupees unless such sum is paid by other than by way of cash. So that's construed as aggregate, or is it like every transaction?
They didn't say aggregate. You are only importing the word aggregate. There is no aggregate.
So does it mean like even in one day, then I'm going to make 2 receipts?
One day is too much tax planning. One day one one receipt, one next day another receipt is general.
When you say aggregate doesn't apply, then
No, that doesn't mean we should be too technical. Sir?
Sir, you have to put the time.
Pardon, sir?
Corpus donation.
Ah.
Has not been defined.
Eligible for 8AG and all this donation.
Corpus donation
Ah.
has not been defined.
It's not defined, eh?
No, is it defined that?
Sir,
What is corpus?
they didn't say corpus donation word. Any specific donation, section 11(1)(d) says, any specific direction given donation shall be excluded from the total income. That's what in section 11(1)(d) exact word is, any specific direction given donation.
Okay. A 12A registered trust gives a donation for another 12A registered trust to make certain expenditure or to make some project. Say also revenue nature. Is it allowed?
Yes, allowed. Same object should be there. Your object and their object should be same. For carrying on the same objects, what I am not able to utilize, you please utilize. I gave a donation. It's a revenue donation. It's 100% allowable as application. 100%, no problem. Okay, sir. Thank you. So we have answered. So all your questions, please send email, sir.
One more question, sir. Sir, for public trust, we discussed ITR 7 should be used, and other cases we should use ITR 5. Then what about the case of private companies gratuity trust fund?
You are right. A private company is having a gratuity trust provident fund trust. That trust is having income. Which ITR form has to be filed? This is question. Public, there is a provident fund, gratuity fund are not entitled to 12A registration because they are not a public trust. It is only under the Income Tax Act trust. So, their income is exempt under section 25. If you see ITR 7, those who claim their income under section 10 exemption shall file ITR 7. The trust is eligible for exemption under section 10 25. ITR 7 only has to be filed.
Okay, sir. What about the audit, sir? The audit and or the audit form to be filed for this case?
Naturally, when it's a public money, you include, there is no audit form like 10B like that. So, you give a general audit report. And then these are all audited accounts, file ITR 7.
So we need not file with the income tax department. Like on the site we need to file any.
This is also a beautiful question, sir. Whenever you are filing ITR 7, 99% without audit report, you will get a demand notice. ITR 7 is for claiming income exemption. A school in the road corner below 1 crore, no audit report form is prescribed. Above 1 crore is only 10 BB, 12A registered 10B, below 1 crore no form is prescribed. But actually ITR 7 asks you, have you got registration? 12A? No. 1023C? No. Any other? You should give any other, that society registration date, number, that trust registration date and number you should give. Have you got your accounts audited? You should say yes. Don't say. Have you enclosed the audit report? Yes. Not the form. Your letterhead, auditors, general audit report. Remove the 10B. Automatically the same audit report. You enclose, then only you are safe. Otherwise say you are not safe. This is the answer. Okay, sir? Thank you. So, any doubts, please give me. And if you want my visiting cards for this email ID or address, I will give you my visiting cards. So, if you want. So, contact me for your doubts because so many people are still having doubts. But time already 8:40. We should. I thank you all for giving me this patient listening. So, I am very kind of you. I will serve you. Thank you so much.